Good morning, students. Welcome you all on the new topic. And this is a topic with which you are well familiar with. So today, friends, we are going to start Ind AS 7 statement of cash flows. Friends, in Ind AS, it is Ind AS 7. In IFRS, it is IAS 7. In accounting standard, it is AS 3. This is one of the standard which I'm sure you must have seen while doing your articleship when you are preparing your financial statement or you are auditing your financial statement. Cash flow is one of the component of the financial statement, right? And this component was there in Indian GAAP as well as this component is there in Ind AS. If I talk about cash flow statement, right, whatever you have read, understood in accounting standard 3 versus Ind AS 7. So there is no much change, or there is, if I talk about fundamentally, so this AS3 cash flow and Ind AS 7 cash flow, fundamentally, structurally, these are the same, right? Barring few differences, which is there in Ind AS 7 versus AS3. But fundamentally and structurally, what we have read so far, what we have seen so far, what we have understood so far in our CA Inter, in our articleship days. So the cash flow remains same. Okay. Just to start this session with a comfort which I want to give to all of you, that this AS3 cash flow and Ind AS 7 cash flow, there is no much difference. Okay. Except the more guidance are given in more guidance is given in Ind AS 7 in comparison to AS3, right? So friends, while talking about component of financial statement, which we have discussed in the second class and the third class of Ind AS 1. So first it is balance sheet, right? And we discussed that balance sheet, the guidance relating to balance sheet is given in Ind AS 1 and division 2 to schedule 3, right? And this balance sheet shows the statement of financial position, right? The balance sheet gives you the financial position of the entity. Profit and loss, again, the guidance is given in Ind AS 1 and the format is given in division 2 to schedule 3. This profit and loss depicts the financial performance of the entity. A statement of changes in equity, one of the new component which we have discussed. The guidance on statement of changes in equity is given in Ind AS 1 and the format is given in division 2 to schedule 3, right? And the statement of changes in equity also provides the performance of the entity, right? In terms of the reserves and surplus, in terms of the shareholder funds. Okay. So then the next component is cash flow statement, right? So I'll come to this particular component, but after that I'll jump onto the notes to accounts, right? So after balance sheet, profit and loss, statement of changes in equity, there is a concept of notes to accounts as well, where Ind AS 1 has given a guidance in terms of what should be included in notes to accounts. You remember it says that you need to provide the basis of preparation, you need to provide the statement of compliances, you need to provide the detailed breakup of balance sheet and P&L in the notes to accounts. You need to provide the requirement of all the standard, disclosure requirement of all the standard, right? Whatever it is required, you have to provide it in the notes to accounts. So the quantitative and qualitative disclosure form part of the notes to accounts. And division 2 to schedule 3, except Ind AS 1 and other Indian accounting standard, division 2 to schedule 3 also provides the guidance on the notes to accounts, right? So friends, if I talk about cash flow statement, and in the yesterday session, as I told you, that the guidance on cash flow statement is not there in division 2 to schedule 3. The guidance on cash flow statement is not there in Ind AS 1. Ind AS 1 only touches this part and it says that the cash flow statement or statement of cash flow has to be prepared by referring Ind AS 7, right? So the only guidance which is given for statement of cash flows is Indian Accounting Standard 7. So this is how this component of the financial statement are structured. And of course, whatever component you are presenting and preparing, 1 year comparative is required to be given, right? Now let's talk about the key feature of the financial statement. One of the key feature, this balance sheet is prepared on an accrual basis, right? This profit and loss and statement of changes in equity is also prepared on an accrual basis. Notes to accounts, of course, notes to accounts are the elaborated, disclosure of the balance sheet item, P&L item and other item. So notes to accounts is not about recognition or measurement. Notes to accounts is more about a disclosure. But this cash flow account, as the name suggests, this cash flow statement is like a cash flow account. It's like a cash account. So this cash account is prepared on a cash basis, right? So that is how when you prepare your cash flow statement, and you all are aware about operating activity, investing activity, financing activity, right? The total of the cash movement of all these three activities, when it will be added to the opening balance of cash, it will give you to the closing balance of cash, right? So it's more like a cash account. Okay. So all the component of the financial statement except cash flow statement has to be prepared on cash basis, right? All the component has to be prepared on accrual basis. Cash flow statement has to be prepared on a cash basis, right? I hope the context is clear regarding this component of the financial statement. Yes, friends. I can see Mansa, Viraj, Tanisha, Pooja, Janki, Rohit, Ridvik on the screen in the board of studies query link. So good morning, guys. Let's move on, friends. Now, what is the benefit of this cash flow statement? How this cash flow statement gives you a good picture about about your entity. Okay, so about the financial results of the entity. So let me share my Excel file and please confirm if my Excel file is visible, guys. Please confirm if the Excel file is visible. Okay. Friends, why analysis of cash flow statement, or why analysis of this cash account, I would say, is important. So let me give you one of the case study here, and you will be able to understand that why it is important, right? Friends, there is a company. There is a company ABC Limited, and the company ABC Limited has a sales of rupees 100 crores, right? This is rupees in crores. Is in crores. Sales of 100 crores, or let's say revenue of 100 crores, I would say, less purchases oblique expenses. Less purchases oblique expenses is, let's say, 60 crores. What is the profit? Profit before this is 40 crores, right? Profit before tax is 40 crores. This P&L account has been prepared on an accrual basis, right? Assuming the entire sales of this company is on credit basis. The entire sale is on credit basis for more than 1 year. Means if you will sell today, you will get the money after 1 year. Okay. The entire purchases and expenses is on cash basis. Employee needs salary every month, right? So your vendor, your creditor needs money on urgent basis. So friends, when I'm looking at the profit and loss account, I'm very happy to see this, right? Why? So in your profit and loss account, these things are not been written there, right? So in your profit and loss account, when you refer it, you will find the company has a huge sales of 100 crores. The company has a purchases of 60 crores, and the company is having a good profit of 40%, right? The company is having a good profit of 40%, which is 40 crores. Great company, I would say. So it's a great company, right? 40%. Now, friends, but when I'm looking at cash flow statement, I am getting a right picture. Okay. So I am a normal person. I am a shareholder. I am a user of the financial statement. When I'm looking at P&L, I am very happy to see the performance of the entity. Then I went to the cash flow statement, and in the cash flow statement, right? So this is my P&L. This is my statement of profit and loss. And loss. Then let's go to the statement of cash flow. Friends, would you invest in this company? Would you invest in this company? Considering this kind of a profit and loss and this additional information, would you invest in this company? Yes or no? Don't know? Okay. Let me put it in a different manner, right? So cash flow from operating activity. I'm looking at the cash flow operating activity. I'll discuss all these things. First, I'm just setting the context. I'm giving you the broad, view of this cash flow statement, why it is important. I'll discuss all the activities one by one with examples, with the practical examples. Okay, don't worry about that. Cash flow from operating activity. Now, when I'm looking the cash flow from activity, operating activity, cash collected from customer, right? Cash collected from customer, zero. Okay. Cash paid to vendor. Cash paid to vendor. This is 60. Cash paid to vendor 60, right? So my net cash from operating activities is negative 60. And even the company would have paid, taxes on this, right? So taxes, less tax. For example, the company is having a 30% bracket into 30% profit after tax. Profit after tax. Profit after tax is 28 crores, right? So net cash from operating activities. So this is my just a minute. This is my cash from operations. Taxes paid. This is also in cash. Taxes paid is your minus 12. Your net cash from operating activity is minus 72. Friends, the company has a profit, net profit of 28 crores. But if you look at the cash flow from operations, cash flow from operating activity is negative. What does it mean? It means the company is not able to generate cash by running this business in the first year, right? That is number one. Number two, the entire revenue, the entire inflow is on credit basis, but entire outflow is on cash basis. It means company needs to have a fund from other sources. For example, financing activity. Company has to take a borrowing, company has to take a loan to fund the business. Company has to take the money from financial creditor to pay to the operational creditors, right? So this cash flow from operating activity says that the company is not able to generate the liquid money which is required to run the business activities, right? Which is required to pay the salary of the employees, which is required to pay the office expenses, office rent, which is required to pay the suppliers of the goods and services. So it means the company is arranging the money from the other sources, like the company is taking a loan from the bank or the financial institution, and then company is paying to the operations, right? So looking at the cash flow statement, of course, if this is kind of a cash flow statement where the operations cash is negative, no one wants to invest in this kind of a company. But when someone is looking at the profit and loss account, so he is finding that a great company having a net profit after taxes 28%, profit before taxes 40%, probably EBITDA is much more than this profit before tax as well, right? So friends, why this thing is there, why this PNL is showing a great performance, and why this cash flow is not showing this kind of a fantabulous performance, just because this profit and loss account has been prepared on accrual basis, right? Accrual basis. And this cash flow account has been prepared on a cash basis. This is prepared on a cash basis. So that is why it is important to see the cash flow statement in addition to the balance sheet and profit and loss as well. Normally, we as a shareholder, we as a user of the financial statement ignore the cash flow statement, right? So we should not ignore the cash flow statement. Rather, we have to refer the cash flow statement in addition to the balance sheet and P&L for judging the company information, for taking any informed decision relating to the company. For example, if you want to join the company as an employee, if you want to invest in this company as a shareholder, if you want to lend the company as a financial institution, if you want to uh, sell your goods and services to the company as a creditor. Okay, so these sort of things you need to look at to understand the company's performance. I hope you guys are able to understand this thing. Yeah. Yeah, is that clear, friends? Very good. I can see a lot of responses. Great. So you guys have understood the context of this cash flow statement. Now let's move on, guys. So this cash flow statement is a very important component of the financial statement, and this has to be prepared according to Ind AS 7. And this is an integral part of the financial statement for each period. So whenever you are preparing your financial statement, this cash flow statement is an important part of that financial statement, right? Friends, before coming to this cash and cash equivalent, let me give you a complete view of the cash flow statement. Then we will come to the concepts of this cash and cash equivalent and other concepts, right? Because this is not a new concept for you guys. So let me take you through the entire journey of this cash flow statement, right? Friends, how many activities are there in the cash flow statement? Can you tell me quickly how this cash flow statement is structured? In which activities you are presenting cash flows? Yes, I'm waiting for your answer. Very good. So cash flow from operating activity, cash flow from investing activity, cash flow from financing activity. Very good. Yes. These are the three activities around which the entire cash flow is getting prepared and presented. So now coming to this cash flow statement, the first activity is I'm preparing this cash statement of cash flows for ABC Limited for the year ending or ended? Year ended. Why? Because these financial statements are getting prepared after 31st March. Okay. For the year ended 31st March 2023. Particulars amount. Let's say this amount is rupees in crores. You remember your currency, your unit of rounding off. This is required to be disclosed. Now coming to the cash flow from operating activities, right? Friends, first of all, how I'll start my cash flow statement, it start with the operating activity. And the first line item is profit before tax. Profit before tax. Assuming my profit before tax is 1000 crores. Okay. This profit before tax comes from your profit and loss account, which is statement of profit and loss. Now, friends, since it is a cash flow statement, and I have taken a profit from the P&L account, from the profit and loss. Okay. The P&L has been prepared on an accrual basis. And there is a very famous line item in the profit and loss, which is a non-cash item. Can you please tell me the name of that non-cash item in the profit and loss? I'm sure everyone has seen that line item in the statement of profit and loss, which is a non-cash item. Everyone has seen that. So friends, in this profit or profit before tax, we have to add or we have to less non-cash item. Non-cash items. We have to add or less non-cash item. Very good. Depreciation. Very good. Depreciation. Yes. Depreciation is the non-cash item. Yeah. Right. Very good. Everyone has given a right answer. For example, depreciation. Impairment. Right. Impairment. Right. This is the non-cash item. So for example, your depreciation. Right. Depreciation is, let's say, 20 crores. Okay. Then you have to add or less. You understand? Because I am using a profit and I have to arrive at my cash, net cash. Okay. So that is why what I am doing, I am adding or I am deducting the non-cash item. This depreciation has deducted my profit. So that is why I'm adding back this depreciation to my profit. It is a non-cash item. What could be the example of other non-cash item? Foreign exchange differences, right? When you are restating your closing items on the closing rate, so of course there is a foreign exchange gap. So this foreign exchange is again a non-cash and a notional item. Okay. So for example, depreciation, impairment, forex differences, foreign exchange differences, unrealized forex, I would say unrealized forex, right? Now, friends, since we are talking about operating activities, so if any item which belongs to investing and financing, doesn't matter, it is a cash item, but it has to be shown in the other categories. That is why we will reduce it from my profit before tax to arrive at cash flow from operating activity. Is that clear? Sir, what could be the example of this? Interest received. Friends, this interest received is part of your profit before tax, right? When you prepare your statement of profit and loss, you start with revenue from operations, other income, total income, then your purchases, cost of goods sold, which is then your expenses, right? Then your depreciation, finance cost, interest paid, then your profit before tax, tax, profit after tax. So this is how you arrive at profit. Okay. So in your statement of profit and loss, all the incomes, all the expenses is included in your statement of profit and loss. And then net you are getting profit or you are getting a loss, right? But in cash flow statement, you have to bifurcate all these cash flows into three activity, which is your operations, which is your investment, which is your finance. Okay. So operating activity, investing activity, financing activity. I hope so far everyone is clear, because this example is very, very, very important example, not only from the examination perspective, rather from real life perspective as well. Okay. So this is the heart of this entire cash flow statement, which I am going to discuss right now, which I'm discussing right now. Okay. So friends, then we have to add or less. We have to add or less what? What? Investing and financing activity items. Okay. For example, let's say, sorry, for example, interest received, right? Interest paid, interest paid, etc. Right? Because interest received is a which kind of item? It's a operating, investing, or financing. If the company business is not to lend money, right? For example, Reliance, for example, Bharti Airtel, they are just depositing their surplus money into the bank and they are getting interest. So this is not an operation item. This is your investing item when they are receiving interest, right? And when they are paying interest on loan, this is a financing activity item. Interest paid is a financing activity item. It is not your operating item, right? Is that clear? Okay. So friends, now we are talking about this investing and financing item, which we have to add or which we have to less. Okay. For example, net, we have item which is 100 crores belongs to your investing and financing activities. Okay. So I'm just assuming a number of 100 crores. So what is this? 20 and 100. It comes out at minus 80. Okay. Minus 80. And this will give you operating profit, operating profit before changes in working capital. Before changes in working capital, right? This is coming at 920 crores. Now, friends, you need to adjust your working capital movement, right? You need to adjust your working capital movement. And why it is important? Let me tell you why it is important. Friends, for example, there is a debtor. There is a debtors. I'm showing you a debtor schedule. Okay. The opening debtor is, for example, 100 crores. Then you have made a sales to the debtors. You have made a sales to the debtor 50 crores. Okay. And the closing debtor is my, for example, 60 crores. Closing debtor is my 60 crores. What does it mean? Initially, my opening debtor was 100 crores. My sales was 50 crores. But the closing is 60. It means the difference is collection. The difference is collection. So how much collection has been done? If the collection would have been 0, the closing debtor would have been 150. It means there is a collection of 90. It means there is a collection of 90. And that's how we are getting this closing balance of 60. As simple as that. So friends, if I'm saying that my closing balance of debtor is less than the opening balance of debtor, means this entire sales during the year has been collected, and over and above this 40 crore has also been collected. So 40 crore has been collected from this opening balance, and entire 50 crore has been collected. This I can say that. Yeah, yes. So net I can say that 90 crore has been collected. Net. So if I look at the debtor balance, debtors, opening balance 100, closing balance 60, it means I have a net, I'm talking about net movement. I have a net movement of 40 crores from the debtors. I have a net movement of 40 crores from the debtors. It means net, I have received the money of 40 crore if I compare my opening with closing. Friends, now when I have to, probably you might have remembered that, sir, operating profit before changes in working capital, we have to just put the difference here, right? You might have remembered this. But what is the concept? What is the logic behind this? That why we are only checking this opening versus closing balance, right? Sir, why not you are taking this entire 90 crore here? Friends, this sale of 50 crore, as I said you, that we have started with profit before tax. And in this profit before tax, while preparing your statement of profit and loss, this sales must have been already taken care of in the profit and loss. This sales is the part of the profit and loss. And that's how you have arrived at the profit. That's how you have arrived at the profit, right? So this 50 crore sales is already a part of this profit before tax. So now over and above this sales of 40 crore, which has been collected from the debtor, it is not coming in your profit and loss. So that is why when your decrease in debtor is there, when your decrease in current asset is there, it means there is a cash inflow. There is a cash inflow. Is that right? The decrease in debtor is there means it is a cash inflow. It means it is a cash collected. It means it is a cash inflow. So friends, add decrease in current asset. Decrease in current assets, right? So whenever the current assets are decreasing, it means there is a cash inflow. Okay. So decrease in current asset, where we have to show? We have to show this decrease in current asset, let's say 100 minus 60. It is a balance sheet item, 100 minus 60, 40 crore. Vice versa, and I'll call it as a, let's say, annexure 1. Annexure 1. Okay. And I'll take another example. to explain, and I'll call it as an annexure 2. For example, the opening was 100 crore, the sales was 50 crore, but this debtor become 120 crore at the end. What does it mean? It means there is a collection of only 30 crores. There is a collection of only 30 crores, right? So what we need to do here? What does it mean? It means the opening was 100, the closing was 120. It means there is a negative cash flow of 20 crores. Means जो आपका ओपनिंग में 100 था वो तो अभी भी 100 है. And this 20 crore has also been added additionally, right, in your debtor balances. It means the 50 crore of sales which is sitting in this profit before tax, out of this 50 crore sales, 20 crore sales additionally has not been collected, right? Right? So friends, that is why less, whenever there is an increase in current asset, you have to reduce it, you have to deduct it. Increase in current assets, right? How much? 100 minus 120. 100 minus 120. Increase in current asset, 100 minus 120. I hope this is clear to everyone. I hope it is clear to everyone, friends. You understood that why we are increasing, decreasing, why we are adding, why we are deducting, how it is moving. Yeah. Even if you have read this in CA Inter, probably you must have understood and have a good revision here, right? Yes. Now coming to the current liability, because working capital is current assets minus current liability. So now let's move to the current liability and let's prepare a creditor schedule so that we will be able to understand it very well. Okay. Coming to the creditor schedule, and let's write annexure 1 here, annexure 2 here. Now coming to my creditor schedule, creditors. Friends, again, my opening, closing. So let's say my, instead of sales, what it will be? It will be purchases. Purchases or expenses, right? Creditor may supply you goods, may supply services, then payments, then closing balance. Okay. For example, the opening balance of the creditor was 100 crores. Okay. Purchases or expenses was, let's say, 60 crores. And the closing balance of creditor become 140 crore. What does it mean? It means there is a payment of only 20 crores of payment is there. Only 20 crore payment is there. Friends, if my creditor balance was 100 in the opening, 140 in the closing, what does it mean? It means I have not paid to the opening creditors. That is number one. Number two, even though the purchases which I have made in this year, I have not made a full payment to the creditor for the current year purchases. So friend, this 60 crore is already coming in this profit before tax. This is already a part of profit before tax. But out of this 60 crore, how much amount has been paid during the year? Only 20 crore. It means you need an adjustment of 40 crore to arrive at a balance of your cash flow from operating activities. To arrive at a cash balance, you need to adjust this 40 crore from your accrual balances, right? So that is why, friends, what you are required to do, whenever there is an increase, in current liability, what you are required to do? Increase in current liability. You have to add or you have to less. Since there is an increase in current liability, you remember this 60 crore purchases must have been deducted to arrive at this profit. This 60 crore purchases or expenses must have been deducted to arrive at this profit on accrual basis. But if we think about cash, out of this 60, how much cash I have paid? Only 20. Only 20. It means I have saved 40. So when I've deducted 60, I have paid only 20. It means I have to increase my cash balances. It means I have to add this to my accrual balance to get my cash balance. Is that clear? Or I can say you just one tip. If decrease in current assets will be added, then of course increase in current liability will be added. Okay. So this will be your positive balance. This will be your positive balance. And here you will take like 140 minus 100. Right? Are you clear on this or should I explain it again? Guys, are you clear on this? Are you clear on this? So Pooja is saying, sir, there could be some other situation also like bad debt. Provision for bad debt. Yes, Pooja. So provision for bad debt is a non-cash item. It's not a cash item. It's a non-cash item. So you need to ignore that provision for bad debt, and then you need to take your your balances, right? For example, if provision for bad debt was there, so you have to gross up with the provision for bad debt. It's a non-cash item, right? And you remember this provisions you would already took in your non-cash item. Yeah. So first profit we have taken. In the profit, whatever non-cash item is there that we have added or reduced. For example, if the company has made a provision for impairment on assets, provision for impairment on trade receivables. So this provision is what? It's an impairment. So we have to add this provisions to my profit before tax to arrive at a cash profit. Then we have to adjust your investing and financing item, right? Then now we are adjusting our difference between opening and closing balance of the working capital, means current assets and current liability. And why? I have already given you the reason, right? Is that clear, Pooja? Yes. So friends, now let's give you the another example of this creditor here. For example, the creditor is 100 crore only, the purchase is 60 crore only, and the closing balance is, let's say, 70 crores. What does it mean? It means there is a 90 crore of payment which has been made to the creditor. It means this 60 crore is only coming in this profit before tax. My profit comes after deducting 60 crore, but actually we have paid 90 crore. It means 30 crore is required to be deducted, right? To arrive at a cash profit from the accrual profit. Is that clear? So friends, whenever there's a decrease in creditors, whenever there's a decrease in creditors, right? Whenever there's a decrease in creditor, you need to, what you are required to do? You need to reduce. You need to reduce it. Okay. So 30, I need to be deducted more. Or I can say that if increase in current asset is deducted, then, then your decrease in current liability will also be deducted. Increase in current assets, ulta, decrease in current liability. Decrease in current liability, right? Again, annexure 1, annexure 2, and this decrease in current liability has to be deducted. Why deducted? I have given you the reason. Okay, is that clear? Very good. Very good, friends. So now I can say that you guys must have understood the construct of the cash flow statement, the construct of the operating activity, that why these things has to be deducted or added, why these adjustments are required, right? In your interview also, these kind of question has been asked in the interview processes as well. So this is your cash flow from operation. This is known as, now this is known as your cash flow from operations. The total is known as cash flow from, just a minute. Okay. So this will be 30 plus 920 plus 30. This is known as cash flow from operation. Cash flow from operations. And when you deduct less, income taxes paid, because you have started with your profit before tax, right? So now you have to deduct income taxes paid, actual paid, right? Income taxes paid. For example, let's say income tax paid is 300. So your net cash flow from operating activities, cash flow from operating activities is how much? 950 minus 300. So 650 is your cash flow from operating activities, right? So friends, what does it mean? It means from net, from hardcore your operations, you are generating a cash flow of 650 crores from your operations. After adjusting your investing item, means you have deposited 1000 crores in your fixed deposit and you are getting 100 crore rupees of interest. This is not your business, right? So that is why we have adjusted it. You are paying a interest on your finance cost, interest on your borrowing. This is again not your business. If you would have your own funds, probably you would not have taken a loan from the bank. So we have adjusted that, right? So whatever non-cash item was there, we have adjusted that. Whatever taxes we have paid, we have adjusted that. We have also reduced that. Net, we got the money we are generating from our business, right? So friends, the cash flow from operating activities shows that how much cash you are generating by running your ordinary activities, by running your business, right? So this cash flow from operating activities shows the cash from running the business, right? The main ordinary activity of the business. So friends, the cash flow from operating activity, the negative cash flow from the operating activity, is it good or bad? The negative cash flow from operating activity, is it good or is it bad? Very good. It is not good. It is bad. Negative means even the management is not able to generate the cash which is required to run the business. It is not good. Okay. So positive cash flow from operating activity is always better. Now coming to the next activity, which is cash flow from or used in investing activity. From means when money is coming, it is known as from. When money is going, it is known as used. So cash flow from investing activity. Now friends, what is cash flow from investing activity? So cash flow from investing activity means the cash flow which are either going out or either coming in from the investment in the business, from the longer run assets in the business, from the investment in the business. For example, if the company is spending huge money in the capital assets, in the property, plant and equipment, the company is constructing and installing new plants, new machineries, right? So what is this? This is your investing activity. Means to support the operations. If the company is investing in the long-term funds to support the operations, if the company is investing in the investment in the long-run assets, it is known as investing activities, right? So purchase of property, plant and equipment, proceeds from sale of property, plant and equipment. So purchase of property, plant and equipment, property, plant and equipment, proceeds from sale of property, plant and equipment, property, plant and equipment. Your interest received, the company has also deposited surplus money in the fixed deposit, interest received. The company has also deposited surplus money in mutual funds or in the shares of Infosys or listed companies. So dividend received, the company has also received the dividend received, interest received, dividend received, right? So for example, the company has invested 2000 crores. The company has invested 2000 crores in the fixed asset. So the company has also sold the old PP scrap sale of 500 crores, let's say. The company has received an interest of 100 crores. Positive. The company has received dividend of 20 crore. Positive. Yes. Whatever company has paid, it is negative. So net, the company has net from the investment, from the investing activity, cash flow from investing activity. Net the company has invested 1380 crores in the investing activities. So what is your investing activities? Investing activities is cash from or used in supporting the operations, right? Supporting the operations. Like you have invested in PP, so you are supporting the operations. Okay. So friends, the negative cash flow from investing activity, is it good or bad? The negative cash flow from investing activity, is it good or bad? Tell me, what's your view? Is it good or it is bad? Mansa is asking, sir, do startups prepare cash flow statement? So Mansa, I will respond in a different manner. If startups are required to prepare their financial statement, for example, they are a company. If they are required to prepare their financial statement as per Ind AS, yes, they are required to prepare cash flow statement. If their financial statement is required to be prepared as per accounting standard, of course, they are required to prepare cash flow statement. But if they are very small entities, they are not a company, they are a very small entity like LLP, partnership firm, and they are level 2, level 3, level 4 kind of entity, then they are not required to prepare cash flow. I'm talking about proprietorship, partnership firm, very small. Some are saying good, some are saying bad. So cash flow from investing activity, positive and negative, you need to look at. Friends, in this case, the case is in front of your screen, is there on your screen. Why this company's investing activity is negative? Because the company is expending. The company has invested a huge amount of money in the property, plant and equipment. What is property, plant and equipment? It means the company is expanding its business. They are investing in the long run assets, right? To expand. So this is good. This is good, right? So you need to look at that. If it is a negative, what does it mean? It means probably the company is investing. If the company has a surplus money from the operations and the company has deposited. The company has deposited in the fixed deposit or investment. For example, let me write here, investment in mutual funds. Since the company has generated money from operations and the company has invested in mutual funds of, let's say, 250 crores. So this will be minus 250. Again, it become negative by 1630. So friends, why the company is invested in mutual fund? Because the company has a surplus money. And by investing in mutual fund, the company will have a yield, right? It could be investment in mutual funds. It could be investment in bonds. You are right, Ritvik. It could be bonds as well. It could be shares as well. So friends, normally the cash flow from investing activity, negative cash flow from investing activity is always good, right? If it is a positive, for example, the company is not investing in your PP, but the company is only liquidating the PP. Company is selling its plant, the company is selling its building, the company is not investing in mutual fund, the company is liquidating the mutual fund. It means the company is liquidating the investment, and that is why they have a surplus fund. Or I can say that the company has a huge investment. So again, you need to look at, if this is the scenario where the company is liquidating its asset, liquidating its investment, that is not good. It means the company is not able to generate money, and that is why they are liquidating these assets for the purpose of business. Second, when it could be positive, for example, the company has a huge treasury of, let's say, 10,000 crores. And every year they are getting a dividend and interest of, let's say, 1,000 crore. And this is the only item they are having in their investing activity. So it will be positive. So you need to look at why your investing activity become positive or why your investing activity become negative. That will give you the right answer. Okay. Upfront answer is not a right answer when you will say that, sir, my investing activity positive is always bad and negative is always good. You need to look at which item makes it negative, which item makes it positive. I hope you guys have understood it very well now. Have you understood it very well now? Is that clear? Mansa is asking, sir, startups are often running in losses. Then why do prepare cash flow statement? What's the use? Mansa, whether cash flow is only required when they are in profit. The P&L has to be prepared on an accrual basis. Might be there could be a situation where there is a losses, but they are not having a cash losses. There might be a cash positive. So again, why you require cash flow statement? So I have covered only two activities so far: operations, investing. Now I am coming to financing activity. So cash flow is required to assess the cash performance of the entity. You can see that even the companies were positive, but there could be a situation where the profit, you remember my first example, when I have said that the 28% PAT is there, 40% PBT is there, still you should not invest in this company. Why? Because the cash from operation was negative, but they were into profit. So cash flow statement is required to judge the liquid performance, right? It's not about that the use is only related to, when you are into profit, then only you need to refer cash flow statement. It's not like that. You need to understand how the business is doing in terms of operation, how the business is doing in terms of investment, how the business is doing in terms of financing, right? For example, if the generally startup has a very heavy negative investing activity. Generally, the startup has a very heavy positive financing activity. They're getting funds from investor. So their financing activity is very positive. Why? Because they're getting funds. Their investing activity is negative. Why? Because they are deploying the funds. They are investing, right? They are investing in assets. They are investing in processes. They are investing in the other campaigns, right? So you need to judge these kind of things, assess these kind of things by referring to the cash flow statement. And then you can take a decision. You have a lot of unicorn startup where people are investing money and they become big billionaires. Okay. So it's not like if it is in loss, then you are not required to refer cash flow statement. You need to refer. Is that clear? And you guys are CA final students, so you guys have to prepare and refer the cash flow statement because this is part of your syllabus and examination as well. So cash flow from or used in financing activity. What does it mean? Financing activity is related to your capital structure. For example, equity share issued, issue of share capital, loan taken from bank, dividend paid on the shares, interest paid on the loan, right? Let's say equity share issued is, for example, 2000 crores. Loan taken 3000 crores. Dividend paid, for example, dividend paid 400 crores negative. Interest paid negative 500 crores. So what is your cash flow from financing activity? It is 4100 crore positive. Is it always good or bad? You need to look at. If the company is regularly taking a loan, it means the company is regularly becoming a debt company. So you need to look at the debt equity ratio. You need to look at what is the size of the fund, what is the size of the equity, what is the size of the business, right? So you need to look at whether it is a heavy debt company or it is a low debt company. Or there could be a scenario where the company has raised equity from the market. And you know that if the company has raised equity, there is no liability to pay dividend. There is no liability to repay the money. So that could be a good position as well. So you need to look at this cash flow from financing activity. It shows the cash from the capital structure of the company. Capital structure means equity, debt, and payment to equity and debt. Payment to equity is dividend. Payment to debt is interest, right? So friends, have you understood all these three activity, or rather I would say, have you revised all these three activities, the logic behind that? and why we are doing this kind of adjustment in the cash flow statement? What is the purpose of these activities and what these activities shows? Have you well understood all these three things? Friends, have you understood this cash flow statement so far? Yes, no. Clear in mind, clear from mind. Yeah, you are right, Mansa. So negative investing activity we consider from the long-term perspective, and that is why it is positive. That's what I've told you. So when the company is investing in long run, when the company is investing in fixed asset, of course it is for long run, right? Very good. So now, friends, when I'll put together all these activity, I wrote uh, A here. So I'll write this cash flow from investing activity as a B here, A, B, and I'll write C here. Net cash changes from all the activities, right? Net cash changes from all the activities. What is your net cash changes? From your A plus B plus C, from your operation, you have generated a cash of 650 crore. From your investing activity, you have deployed a funds of 1630 crores. From your financing activity, you have generated a cash of 4100 crores. So this is your A plus B plus C. A plus B plus C, right? And friend, for example, this is your opening cash and cash equivalent. Opening cash and cash equivalent. Your opening cash and cash equivalent is, let's say, 250 crores. So your closing cash and cash equivalent, your closing cash and cash equivalent, closing cash and cash equivalent should be how much? It should be 3120 plus 250. It must be 3370, which should be tallied with the balance sheet, right? It should be tallied with the balance sheet. Tallied with the balance sheet. Is that clear? This is how this cash account has to be prepared. This is how this statement of cash flow has to be prepared. Okay, very good. I can see a lot of students providing the response clear in mind. So they know that this is the, the way they need to respond. Clear in mind, clear from mind. Okay, very good. So love to see the responses from all of you. So now let's come to some notes. Friends, operating activity means activity relating to the principal assets, relating to the principal revenue producing activity. So operating activity means activity relating to the principal revenue producing activity, right? Investing activity means acquisition and disposal of long-term assets. You remember, Mansa? Long-term assets and investment other than cash and cash equivalent. If you are investing in your bank, I mean to say, if you are depositing money into your current account, that is not investing activity. That is your cash and cash equivalent, right? Financing activity or activity relating to the capital structure of the entity, equity, debt. Cash flow statement is required to be prepared on a cash basis, right? All the other component are on accrual basis. Cash flow statement is on cash basis. That is why these all adjustments are required in this operating. You remember? Add or less non-cash item, then changes in working capital, right? This is why it is required. Okay. Friends, the method of preparation of cash flow statement, there are two methods, direct method, indirect method. Okay. If I talk about operating activity, there are two methods, direct method as well as indirect method. If I talk about investing activity, there is only direct method. If you have purchases fixed asset on a credit basis, you are not required to show the purchases of fixed asset in investing activity. Why? Because there is no cash which has gone out. So your investing activity will always be on a direct method, means the direct cash which has gone out, the direct cash which is coming in. So net. Okay, it is. So that's why you will not see any adjustment in your investing activity and financing activity. Have you seen any adjustment in investing and financing? But you have seen a lot of adjustment in your operating activity. Your add or less non-cash item, add or less investing and financing item, then operating profit before changes in working capital, then working capital movement, right? But the adjustments are not there in investing and financing activity. Why? Because investing and financing activity is always required to be prepared on a direct method. Direct cash which has gone out, direct cash which has come in. We have one case study from the study material on this part. We will do that. Okay. Operating activity, two methods, direct method, indirect method. What is meant by direct method? Direct method means, for example, here, if I talk about the debtor balance. So here I have adjusted the net movement of debtor in the working capital. Why? Because in this example of Annexure 1, where the sales was 50 crore and the collection was 90 crore, but I have shown only 40 crore in my working capital movement. Why not 90 crore? Because this 50 is already coming here, right? So friends, in your direct method, it is not start with profit. It start with cash collected from debtor. If I would have prepared this cash flow statement, cash flow from operating activities on a direct method basis, I would not have been start with profit. I would have start with cash collected from debtor, cash paid to supplier, cash paid to vendor, cash paid for taxation, right? So I would have used this 90 crore. I would have used this 20 crore instead of this movement of 100 and 140. Are you getting me? So net cash which is going out from the cash which is going out to the vendor, supplier, or for purchases of goods and services, or cash which is coming in from the sales or from the collection from the customer or debtors. So the net case direct cash is showing as a cash flow from direct method, right? So we will discuss this in detail also. Is that clear? So these are the method of preparation of cash flow statement. But friends, listed companies are only allowed to use indirect method of operating activities for preparation of cash flow statement as per SEBI regulations. Okay. So listed company always use indirect method. They start with the profit, then they adjust non-cash item, they adjust investing financing item, then they adjust working capital movement, then they adjust taxes paid, then they come to the cash flow from operating activity. Clear? Now I am going back to my PowerPoint presentation. I have spent a good 45 minutes on this cash flow statement. Yes, Pooja, the example we did, it is an indirect method. For all the listed companies, indirect method is mandatory. And normally in your real life, you will see the cash flow statement on the basis of indirect method, right? Okay. Now the first thing, cash and cash equivalent. Sir, what is the meaning of cash and cash equivalent? It comprises of two parts, one cash and the second cash equivalent. Cash comprise cash on hand and demand deposits. It comprises cash on hand, the cash which you are having in your pocket, in your tijori, in your locker. So this is cash on hand. And demand deposits means like cash in bank account. So you have the cash in your saving bank account. Is it cash on hand? Yes, it is kind of a cash on hand. It is kind of a cash. You go to the ATM, you can withdraw money even on Saturday and Sunday as well, right? So you have to pay someone, you will just do NEFT, you will just do IMPS, and you can pay the money, right? Friends, this cash comprises cash on hand and demand deposits. Cash on hand and demand deposits. Okay. What is cash equivalent? So cash is pretty simple. Your cash in hand and your cash at bank, or it's like a demand deposits, right? Demand deposits means if you have deposited into the bank, you can withdraw, you can liquidate whenever you demand that, whenever you require that. So it is like a demand deposit. Okay. Coming to the cash equivalent means it is not cash, but it is equivalent to cash. Cash equivalent are short term. Please write down what is meant by short term. Short term means up to 3 months. Short term means up to 3 months, right? Up to 3 months. Short term. Cash equivalents are short term, highly liquid investments. So it is investment which is highly liquid that are readily convertible, to non amount of cash, which are subject to insignificant risk, of change in value. Friends, the company has invested in the shares of Infosys Limited. And when the company has invested, the share price was 1500 rupees. The share price was 1500 rupees. Friends, is it a highly liquid investment? So I am asking the first question. I'm not asking cash equivalent. I am asking, when the companies are investing in the shares of the listed companies, is it a highly liquid investment? That was my first question. Is it a highly liquid investment? You are right. Yes, it is a highly liquid investment. Why? Because if you have purchased today, tomorrow you can sell in the market. When the market will open, you can sell the shares. It's a listed company, no? Sumit is saying yes. Ridvik is saying yes. Sarvanan is saying no, and Muhammad Abdul is also saying no. Why? Why no? Vansika, you're also right. Because it can be sold in the stock market, no? It is a highly liquid investment. You have a demat account, you have a trading account. You are not required to go anywhere. The market will open at 9:30 and you can sell that. Right? You can sell it just within a day. Right? And I am talking about that cash equivalent are highly liquid investment which can be liquidated into cash in 3 months. In 3 months. I am giving you 3 months time. And even the stocks can be sold in the next day only. I have just purchased a share last week on Friday, and I've sold yesterday. So I've just sold in the 4 days, right? It is easily convertible. It's a highly liquid investment. Friends, is it a cash equivalent? So for being an item, a cash equivalent, 3 months criteria is not the only criteria. It is one of the criteria. The second criteria is cash equivalent are short term, means within 3 months, those investment which can be liquidated within 3 months, right? Are short term highly liquid investment that are readily convertible to not cash, to non amount of cash. What is meant by non amount of cash? Means certainty, means certain amount of cash, means certain amount of cash, certain amount of cash, right? Certain amount of cash. Friends, if you have invested in shares of Infosys today at 1500 rupees, can you give me a guarantee that I'll sell after 3 days and I'll receive 1700 rupees? Do you know that how much money you are going to convert, how much money you are going to make, or how much money you will convert from this investment into a cash? Are you aware about that? Are you aware about this? Do you have this convertibility into a non amount, into a certain amount of cash? Answer is no. Tomorrow or day after, it could be 2500, it could be 500, right? But fixed deposit, you can say that if I've invested today, after 3 months, I will be getting so much amount. After 1 month, I will be getting so much amount. Even after 7 days, I will be getting so much amount. Yeah. So friends, although it is a short-term, highly liquid investment, but it is not convertible to non-amount of cash. And which are subject to insignificant risk of change in value. No, these are subject to significant risk of change in value. So whatever I've invested today, tomorrow, day after, 1 month, 2 months, 3 months, there could be a huge change between what I have invested versus what I'll get. Last week, or even in the last week, when the stock market fell for the continuously 3 days, you know, close to 10 lakh crore of money of the investors was destroyed, right? So the money, when the stock market plunges for continuous period of 3 4 days, 10 lakh crore of the investor का खत्म हो गया, right? So there is a significant risk of change in value. So that is why investment in equity share, it is an investment, it is not a cash equivalent, although it is a highly liquid. Is that clear? Clear in mind or clear from mind? So friends, cash include cash on hand, demand deposits, cash at bank, right? So this is known as a cash. Cash equivalent means short-term, highly liquid investment, which can be readily convertible into non-amount of cash and which are subject to significant risk of change in insignificant risk of change in value. Like fixed deposit for 3 months is a cash equivalent. Fixed deposit for 12 months is not a cash equivalent. Why? Because it is beyond 3 months. Is that clear? Friends, we understood cash and cash equivalent. Now there is a difference between accounting standard and Ind AS in the treatment of cash and cash equivalent. It says that the cash and cash equivalent includes bank overdraft as well, if part of cash management activity and balance fluctuate between positive and negative account. You understand what is a overdrawn facility, what is a bank overdraft? So if you have a bank overdraft facility, for example, you have a current account with the bank and you have also taken a bank overdraft facility. So what will happen? For example, you have a 1 lakh rupees you have a 1 lakh rupees in your bank account and you have issued a check of rupees 1,50,000 and the recipient of the check has deposited the check in his bank account, and you have only 1 lakh but you have issued a check of rupees 1,50,000. So still you have only 1 lakh rupees, still the check will be cleared from your bank account. Why? Because you have a bank overdraft facility. And in that case, your bank balance will be overdrawn by 50,000 rupees. Right? At the end of the year, it will show you negative 50,000, means you have to pay to the bank to the extent of 50,000 rupees. It is a bank overdraft. Normally, why company use the OD facility or bank overdraft facility? To manage the working capital, so that they used to issue the checks and those checks will not get dishonored. Okay. So friends, if I talk about balance sheet, this bank overdraft has to be shown as a short-term borrowing in the balance sheet. But for the cash flow purposes, standard says that this bank overdraft is like it is using in a cash management activity to manage the working capital, and the balance fluctuate between positive, negative, high negative, low negative, right? So it is more like a cash equivalent. It is more like a cash equivalent where you are managing your cash. So in Ind AS and IFRS, if there is a bank overdraft, it has to be adjusted with cash and cash equivalent, right? Only in the cash flow statement. Is that clear? Is that clear or not clear? How is it? How is it shown? Let me show you. Let me show you. Please let me know if you are able to see the Excel file. Please confirm. For example, let's put it here only. Treatment of bank overdraft. Balance sheet. In balance sheet, assets are there. Assets, right? In assets, there is a cash and cash equivalent. Then there is a liability. In liability, there is a short-term borrowings and there is a bank overdraft as a part of the short-term borrowing. For example, this is 100 crores. And for example, this is, let's say 20 crores, right? Now coming to the cash flow statement. Statement of cash flow. In a statement of cash flows, there will be a cash flow from operating activity. There will be a cash flow from investing activity. There will be a cash flow from financing activity. Right? For example, it is 200 positive, it is 150 negative, it is 800 positive, right? So the entire net cash changes is 850. Your opening cash and cash equivalent, and this is your current year. Let's say 31st March 23, and this is your last year comparative 31st March 22. Let's say this is 70, okay, and this is 0. So in the opening it is 70, and just give me a minute. 850 plus 17, 920. So I'll make it this as 1,000, and I'll make it this as 80. So friends, normally in accounting standard, we were adjusting this bank overdraft as a loan from the bank, and that is why it was a part of cash flow from financing activity. But in this case, this bank OD will not be the part of your financing activity. Your closing cash and cash equivalent will come out like 1,000 minus 80. 1,000 minus 80. So this 850 plus 70 is 920. So this is how it has to be adjusted. In the balance sheet, the asset and liability has to be shown separately, but in cash flow, this closing cash and cash equivalent, this cash and cash equivalent is net of your bank overdraft, right? And how this, if you are a user of the financial statement, you will get confused. In your balance sheet, it is 1,000. In your cash flow, it is 920. You will get confused. So that is why standard says that you have to provide a reconciliation between the statement of cash flow and balance sheet. You have to provide a reconciliation also. Now you need to provide a reconciliation. Reconciliation of cash and cash equivalent. You need to write cash and cash equivalent. H per balance sheet. H per balance sheet. 1,000. Less bank overdraft. 80. Then it is coming out cash and cash equivalent H per cash flow statement. Let's say this is a note number one. For example, this is your note one. And here it will be written like refer note one. So I am the shareholder, I am the user of the financial statement. I don't know Ind AS. So when I'll see the balance sheet, I'll found, oh, 1,000 crore cash is there. When I'll see cash flow, oh, 920 cash is there. Why it is not telling? In accounting standard days, it was always telling. But why it is not telling? Or it could be a position where even if your cash and cash equivalent is zero, your cash and cash equivalent could be negative here. It could be negative here, right? So I'm surprised why my cash and cash equivalent can be negative. It is negative just because of bank overdraft. So then I have seen that there is a note number one. And when I went to note number one, I got to know, oh, the cash and cash equivalent as per balance sheet and as per cash flow is not matching. Why not matching? Because there is one element of bank overdraft which has been adjusted in the cash and cash equivalent in the cash flow state. Right? So friend, this is all practical part which is there in the company's balance sheet. Generally, this is always there. Generally, this is always there in the company's balance sheet. Generally, right? Is it clear? Is it clear, friends? I hope it is clear to all of you. Let me know if you have any query. Otherwise, I'll move on. Yeah. Is it clear? Not clear? I'll show you one practical example here from the listed company balance sheet as well. I'm just opening the balance sheet. Just give me a minute. Can you see this balance sheet of Adani Enterprises Limited? Can you see this balance sheet? In the balance sheet, you can see that there is a cash and cash equivalent, right? Note number 15, cash and cash equivalent, right? They have given this number in balance sheet. 63 and 18 is the number. Then let's go to the cash flow statement. In the cash flow statement, this is there, right? So although in this company, bank overdraft is not there, hence the number is same. But they have given the notes to the statement of cash flow reconciliation with the balance sheet, right? Cash and cash equivalent as per balance sheet. So here it is telling why? Because the bank OD is not there. Had the bank OD been there, then the same reconciliation will come and one line item bank overdraft will also come, and whatever reconciliation I have shown you, that will be that kind of the reconciliation. Okay. Is that clear, friends? Is that clear? Mansa, do you have any doubt? Yes, so quickly we'll again move to my PowerPoint presentation. We discussed cash and cash equivalent, we discussed the bank OD concept, and quickly from the institute study material, let's discuss this illustration number one, and then we will have a break. Company has provided out the following information regarding the various assets held by the company on 31st March 2001. Find out which of the following item will be part of cash and cash equivalent for the purpose of presentation of cash flow statement as per guidance provided in Ind AS 7. Friends, the company has deposited fixed deposit. The company has fixed deposit with State Bank of India, 12%, 3-year maturity on 1st January 2004. Friends, this FD will get matured on 1st January 2004, means after 2 years and 9 months. Is it a cash and cash equivalent? It cannot be. It is a long-term asset. It cannot be. Your cash and cash equivalent are the short-term, highly liquid assets, right? Right? So it is not a cash and cash. So your cash and cash equivalent are short-term, highly liquid investment, which can be convertible into a non-certain amount of cash and which is not having significant risk of change in value, or I can say that which is subject to insignificant risk of change in value. So what is meant by insignificant risk of change in value? For example, if you have deposited money, right, in the bank. So IDFC First Bank, I'll take my real life example. I have a, let's say 10 lakh rupees in the bank account of my IDFC bank, right? So what happened? So IDFC was providing 7.5% interest on my saving bank account. So I know that if I have a 10 lakh rupees, I'll get 7.5% every month. So they are crediting every month. It is not 7.5% monthly basis, it is 7.5% per annum. So few months back, they have reduced the interest rate. So what I'm expecting, it has gone down, but it is not significant. It is not like that this 7,500 become, I would say if 10 lakh pe agar 75,000 ka interest aata, so it is not 500 or it is not 1.5 lakh. So this 75,000 becomes 70,000 or 72,000, right? So this is the meaning of insignificant risk of change in value. But in stock market, of course, you are not aware. It could be like anything. Money can be double in 3 days, or money will not be a money in next 3 days, right? So fixed deposit with SBI, it is for 3 years. It is not a cash and cash equivalent, right? Number two, fixed deposit with HDFC. Very important question. 10% original term was 2 years, but due for maturity on 30th June 2001. So reporting date is 31st March and this date is 30th June, which is 3 months. Is it a cash and cash equivalent? Friends, for cash and cash equivalent, you have to see the 3 months from the original date of deposit. If the original maturity was 3 months, then it is only a cash and cash equivalent. Matlab, sir, for example, 2 years back, you have deposited a fixed deposit. You have deposited money into the bank as a fixed deposit. That money is going to be mature. So when you have invested in that fixed deposit, of course, it was a non-current asset because it is for 2 years. Last year, the remaining period was, let's say, 1 year and 10 days. Again, it is a non-current asset. Now in this year, it is going to mature on 15th April and we are sitting on 31st March, means going to be mature after 15 days. So it is not a cash and cash equivalent. Why? The original period was never 3 months. The original period was more than 3 months. But now the remaining period is 3 months, less than 3 months only. So it will not become your cash and cash equivalent. It will become your cash and bank balances, or I would say it will become your current asset only, but it is not a cash and cash equivalent per se. Have you understood? So for this 3 months period, you have to see the original maturity. So third example, the company has deposited money into the fixed deposit of a bank on 15th March for a period of 1 month. So this will be going to mature on 15th April. Is this a cash and cash equivalent? Yes, this is a cash and cash. Is that clear? Is that clear? The company has deposited money on 15th January for a period of 4 months. So this 15th January deposit will get matured on 15th April. Is it a cash and cash equivalent? Answer is no. Sorry, on 15th May. 4 months means 15th May. Is it a cash and cash equivalent? Answer is no. No, it is not a cash and cash equivalent. It will be shown as a other financial asset in the current asset category. 3 month period is to, Sumit is asking, sir, whether 3 month period is to check from reporting date. Answer is no. 3 month period has to be checked from the original date of deposit. I hope it is clear to everyone. I have given 3 examples to support this. 2 year, then remaining period is less than 3 months, then original period is less than 3 months. Number 3, redeemable preference share. Preference share, it is not volatile, it is fixed and it is redeemable. That is why it is like a liability for the company. Acquired on 31st January, redemption on 30th April. The original period is 3 months, right? And this is having insignificant risk of change in value. And even the amount is known. So it is a cash and cash equivalent. This So this is not a cash in cash equivalent. This is not a cash in cash equivalent. This is a cash in cash. Cash balance at various bank. Of course, cash in cash equivalent. Cash balance at various bank international branches. Cash and cash equivalent. Yes. Branches of foreign bank outside India. Yes. Bank overdraft, which is payable on demand. Yes. Cash and cash equivalent. Treasury bills, 90 days maturity. Yes. Cash and cash equivalent. Right. Right, friends. So these are the example. These are the answers. Whatever we have discussed. Right. This is the reason for why we are saying yes, why we are saying no. Do let me know if you have any doubt here. Otherwise, I'll I'll have a 10 minutes break and then we'll start the session. Sir, for point number two, can Supraza is asking for point number two, can it be treated similar to short-term maturity of long-term borrowing? No. Yes. It can be treated like that. Okay. So basically, Supraza, in balance sheet, let me show you the balance sheet first of all. Please confirm if the balance sheet is visible. Please confirm. I hope this balance sheet is visible. In the balance sheet, you can see in the current assets, there is a cash and cash equivalent. And then on the current asset side only, there is a bank balance other than three above. So all the cash in hand, cash at bank, and and demand deposits and your cash equivalent, which can be convertible into a non-amount of cash within a original maturity period of 3 months. The original maturity period of 3 months will cover here. But the deposits or cash equivalent, or I would say deposits, whose original maturity period was not 3 months, whose original maturity period was longer, but on the reporting date, the remaining period is less than 3 months. So those will come here. Bank balances other than three above. So those will come here. But the cash equivalent, where the original maturity period is up to 3 months, will come in the cash and cash equivalent. I hope it is clear now. I hope it is clear now, Supraza. Great. I can see a lot of, good feedbacks, good responses on around this. So guys, we have covered this cash and cash equivalent part in a very detailed manner with all the disclosure and reconciliation. So now it's 8:33 now. So instead of 10 minutes, let's have a 7 minutes break and I'll start at 8:40. Okay. Oops. Can I move forward? Do you have any questions? No? Very good. Yeah. So this we have already discussed. What is your operating activities? What is your investing activity? What is your financing activity? We understood operating activity relates with operation, investing relates with investment, and financing relates with the capital structure, right? So operating activity has to be, the preparation of cash flow from operating activity is basically through direct method as well as indirect method. While direct method, you are not adjusting, you are not arriving from accrual to cash. You are directly only consolidating the cash balances. Okay. So friends, with our knowledge of this cash flow statement, let's discuss what is the operating cash flows, right? What is the operating cash flows? From the following transaction, identify which transaction will be qualified for the calculation of operating cash flows. If company is into the business of trading of mobile phone, this is a company which is into the business of trading of mobile phones, and you need to tell that which items will come under the cash flow from operating activities, right? And you have to keep in mind the cash flow from operating activity relates to the operation of the business, right? Second, if it is a non-cash item, it will not be the part of cash flow from operating activity. It means it has to be adjusted, right? Non-cash item is not a cash part, okay? Or if it is an investing and financing related item, again it is not a part of cash flow from operating activity. It is not a cash flow from operating activity. Not a part means it is not a cash flow from operating activity. That is why it is added or reduced, deducted. Receipt from sale of mobile phone. The company is getting money from the sale of mobile phone. Is it a cash flow from operating activity? Is it a cash flow from operating activity? Yes or no? Friends, can you quickly tell me the answer? Yes, very good. It is a cash flow from operating activity. It is a cash flow from operating activity. Yes. Purchase of mobile from phone from various companies. Of course, yes, it is like a purchases. It is your cash flow from operating activity. Employee expenses paid. Employee expenses paid. Yes, it is a cash flow from operating activity. Advertisement expenses paid. Yes, it is a cash flow from operating activities. Credit sale of mobile. Credit sale of mobile. Is it a cash flow from operating activity? You have sold the mobile, but you haven't received any cash. So if you have not received any cash, what is your operating activity? Cash flow. There is zero. You remember my first example where the sale was there, but entire sale was on credit basis. So in the operating activity, the cash collected from customer was zero. You remember that example? So the credit sales of mobile, there is no cash, right? So it is not a cash flow from operating activity because there is no cash flow. It is a non, there is no cash flow. Miscellaneous charges received from customer for repair of mobile. Yes, it is an ordinary activity of business from which the company is getting money. Loss due to decrease in market value of the closing stock of old mobile phone. The company has an old mobile phone inventory and the market value has been decreased for those inventory. Is there any cash movement? There is no cash movement. You have a house, right? And your house was worth 1 crore rupees. The value of how your house got reduced to 80 lakh rupees. So the market value has gone down or market value has gone up. How does it matter? There is no cash movement. So there is no cash movement. Okay. So no cash flows from operating activity. Payment to supplier of mobile phone. Of course, yes. Depreciation on furniture of sales showrooms. Depreciation on furniture of the showroom. It is a non-cash item. Interest paid on cash credit facility of the bank. It is a financing item. It is not an operating item. Profit on sale of old computer and printer in exchange of a new laptop and printer. The company has exchanged new laptop and printer and given old laptop and printer. Is there any cash movement? Answer is other, even though it would have been the investing activity. Advance receipt from the customer. The money has been received in advance. Money is coming. Yes, it is a cash flow from operating activity. Sales and excise duty paid. Taxes paid. Yes, it is cash flow from operating activity. Friends, do let me know. Inventory will always be non-cash item. Answer is no. Sumit, if you correctly read this line item, it says that there is a decrease in market value of the inventory. It is not saying that the company has received the less money. If the question would have been whether sale of inventory is a cash flow from operating activity, answer is always yes. Whether increase or decrease in the value of the inventory, is it a cash flow from operating activity? First of all, my question would be, is it a cash flow? Answer is no. If it is not a cash flow, it will not come anywhere. Right? Right, Sumit? So friends, this is what we have discussed, and the answer is also given with the explanation that why it is yes, why it is a operating activity, why it is not an operating activity. Okay. So there is a direct method and there is an indirect method. In direct method, it is a direct cash method. Indirect method means accrual to cash. In direct method, no adjustment is required. Major class of gross receipts and gross payments of cash are disclosed. In indirect method, from profit before tax you will start. Then you have to add a non-cash item. You have to adjust investing financing item. You have to adjust working capital movement. Then you will arrive net cash from operation. And then you'll deduct the taxes and you'll get the cash flow from operating activity. Right? This part we have already discussed. Now, friends, from Institute illustration number 6, let's discuss the cash flow from operating activity from the direct method. The Excel file, in Excel file, what we have discussed, it was indirect method. Let's discuss direct method cash flow as well. Okay. Find out the cash flow from operations by direct method and indirect method from following information. Doesn't matter you will follow direct method or you will follow indirect method, the answer will remain same. Doesn't matter. Okay. Sales doesn't know whether it is a credit sales or it is a cash side, because we will not start with profit. We will start with major line item where cash received and major line item where cash paid. Interest paid, of course, it is a cash item, but not a operating item. It is a investing and financing item. We have to arrive at cash from operations. Interest paid, financing activity item. Loss on sale of asset, it is again more of an investing item. Profit before tax, then 30,000 tax is there, and this is the profit after tax. These information is given in this question. Then further balance sheet, and the further balance sheet is given. So this is the P&L statement. This is the balance sheet. In the balance sheet, non-current asset PP is there. Investments are there. Inventory. The inventory has been increased from 12,000 to 13,000. Right. It means there were purchases also. Debtors has been increased from 10,000 to, sorry, debtors has been decreased from 10,000 to 7,000. You know, there was a sales also, 5 lakh rupees. There was a sales of 5 lakh rupees. There was an opening debtor of 10,000 rupees, but still the closing debtor is less than the opening debtor. What does it mean? It means the company has collected cash more than whatever it has sold to the customer. Am I right? This is what we have discussed in the first session. First example. You remember? So we need to arrive at cash collected from the customer. And what is my cash collected from the customer? My cash collected from the customer is collection out of the current period sales and the collection out of the past period sales. Right? Cash and cash equivalent is 6,000, and so from 5,000 it has become 6,000. Sorry guys. So this was the comparative number. So I would say your creditor, your inventory has been reduced from 13 to 12. Your receivable has been increased from 7 to 10. Your receivable have been increased. This means you have collected money less than whatever you have sales. Your cash and cash equivalent has also been increased, right? shareholder fund is there, non-current liabilities, and then your creditor has also increased. It means whatever the company has purchased, the company has paid less than the purchases even during the period, right? So this is the balance sheet which is given. This is the balance sheet which is given. Okay. So now, friends, we need to compute the cash flow from operations by direct method. Mansa is asking, sir, if the entity is a listed company trading in mobile phone, then loss due to market value of the closing stock, would it be treated as financing activity? Mansa, I'm not able to understand why you are asking this question. First of all, doesn't matter is it a listed company or unlisted company, doesn't matter. Number one. Number two, the loss due to market value of the closing stock, it is just like a notional loss. It is a non-cash item. It is like a impairment. You remember you have you read AS2? Have you read AS2? Accounting Standard 2, inventory. So inventory has to be measured at cost or NRV, whichever is lower. So whenever your net realizable value become lesser, you have to book the impairment of inventory, impairment on inventory, right? So it is a notional loss. There is no cash movement on that closing stock. So this is neither investing nor financing nor operating item. But had it been the actual loss or profit on the sale of inventory or on the purchase of inventory, it would have been operating item. It is not a financing item. Why it could be financing item? The company's bread and butter is to get the money from the sale of that phones, from the trading of phone. Financing activity only consists of your capital structure related activity. For example, when you issue share capital, when you take a loan from the bank or financial institution, when you pay dividend, when you pay interest, this is your financing activity. Trading of inventory, how come it be financing activity? It cannot be financing activity. It is an operating activity. Guys, I hope I have explained you. I have spent a lot of time in explaining your operating activities, your operations, your investing activities, long-term assets, your financing activities, your capital structure means equity and debt, from where you are financing the operations. I hope you guys have understood operating, investing, and financing, or you have not understood this thing. Have you understood or haven't you understood that? Yeah. So because that is a fundamental thing. If you have not understood, I'll repeat it again. Inventory is a ordinary activity. Inventory is the bread and butter of the management or bread and butter of the company. Anything which is related to inventory is a operating activity. But if only the value is going up and down, and I have also taken the example of your house, right? I have taken in the example of your house also. The house in which you are living, if the value is increasing or decreasing, there is no cash flow. But when you actually sold your house, it will be your cash. So if there is no cash flow, it will not come to your cash flow statement, right? It will not come to your cash flow statement. Okay, let's move on. Now we need to prepare the cash flow statement by direct method. While preparing the cash flow statement by direct method, we need to calculate the cash collection and the cash payments. How the cash will be collected? The cash will be collected from the customer. So friends, what could be the transaction with the customer? Number one, what is the opening balance of the customer? What is the closing balance of the customer? Please remember, the opening balance of the customer is 7,000, the debtor's balance, and closing balance is 10,000. So opening 7,000, closing 10,000. And there was a sales also for 5 lakh rupees. So opening 7 lakh plus sales of 5 lakh, technically we would have received 5 lakh 7,000, right? But we have a closing balance of 10,000. It means how much money we have collected from debtor. So how to prepare this schedule? So sales is 5 lakh, opening balance is 7,000, closing balance is 10,000. It means my cash collection is 4,97,000. You understand that? I have sold my goods to the debtor for 5 lakh rupees. And I was also required to pay my debtor I was also required to collect from my debtor the opening balance of 7,000 rupees. The total money which I had to receive from my customer is 5 lakh 7,000 rupees. But still, 10,000 rupees still outstanding. It means what net I have received? I have received 4,97,000 rupees during the year. So this is my cash collected from the customers, right? 4,97,000 rupees. Now I need to go to the cash purchases. Now I need to go to the cash purchases. Number two, my inventory balance is 13,000 in the opening, 12,000 in the closing. My cost of goods sold is 3,50,000. So first of all, I need to compute the purchases. How much I have purchased, right? So cost of goods sold is 3,50,000, means the goods I have actually sold worth 3,50,000 rupees. Still, I have an inventory worth 12,000 rupees, but I was having an opening inventory also worth 13,000 rupees. It means net purchases which I have made during the year is 3,49,000 rupees. Are you able to understand that? That's what I have done now. So net purchases which I have made during the year is 3,49,000 rupees. And friends, I have a creditor outstanding. It was opening 8,000 rupees, but closing creditor outstanding is 12,000 rupees. It means even whatever I purchased during the year, I have not paid completely to them. So my purchases is 3,49,000. My opening creditor is 8,000, but my closing creditor is 12,000. It means net, the amount I have paid to creditor is 3,45,000, right? 3,45,000. Is that clear? So friends, my cash purchases is 3,45,000, which is coming from note number 2. Is that clear or that is not clear? Tell me. Is that clear? If it is not clear, I would be happy to explain it again. Yeah? Is that clear, friends? This cash collected from debtor calculation, cash paid to the creditor calculation, is that clear? How I arrive at the purchases, how I have arrived to the net payment to the creditor? Yes or no? Shall I move forward? Okay. So Pooja is asking purchase again. Okay. So Pooja, the opening stock was 13,000 inventory. The closing stock was 12,000. Right? This is clear. And during the year, the goods sold is 3,50,000. So if I was having a opening stock of 13,000, right? And I have sold the goods worth 3,50,000, means the purchase cost was 3,50,000. The cost was 3,50,000. So I had an opening inventory of 13,000. I had purchased, or let's say I have sold, not purchased, I have sold goods worth 3,50,000. So 13 plus 350, how much? 350 plus 13, how much? 3,63,000. 3,63,000, right? So my opening inventory is 13,000, na? My opening inventory is 13,000. And I have sold goods worth 3,50,000. So, and I have a closing inventory of 12,000. So if I have an opening inventory of 13,000 and I have a closing inventory of 12,000, what does it mean from opening to closing? It means I have used 1,000 of inventory from the opening balance. मेरा ओपनिंग से क्लोजिंग में 1,000 की इन्वेंट्री कम हो गई. What does it mean? It means I have used 1,000 rupees of inventory from the opening balance, right? And during the year, I have sold गुड्स कॉस्टिंग रुपीज 3,50,000। सो मेरी ओपनिंग से क्लोजिंग में इन्वेंट्री सिर्फ 1,000 की कम हुई, पर मैंने 3,50,000 वर्थ के गुड्स बेचे हैं। सो व्हाट डज इट मीन? इट मीन्स 3,49,000 आई हैव अ फ्रेश परचेजेस ड्यूरिंग द ईयर। इज दैट क्लियर? और आप इसको कैसे निकाल सकते हो? योर कॉस्ट ऑफ गुड्स सोल्ड इज 3,50,000, योर क्लोजिंग इज 12,000, योर टोटल goods lying in godown and goods already sold is 3,62,000. But you had an opening inventory of 13,000. So 362 minus 13 is 3,49,000. This is the value of your purchases. Yeah, this is the value of your purchases. Is that right, Pooja? And if you have purchased for 3,49,000 and you had an opening creditor of 8,000, right? It means the total money which you are supposed to pay is 349 plus 8, 357. But still, 12,000 is still outstanding. It means 357 minus 12, 3,45,000 you have paid to the creditor. You have paid to the creditor, right? So this is what I have written here. 497 collection, 345 payment. Now, friends, let's go to the P&L again. So this sales we have covered, this cost of goods sold we have covered. Now there are overheads of 55,000, right? And let's look at the payable for expenses. It is written there that the payable opening it was 7,000, closing it is 10,000. It means even the expenses which we have incurred in this year, we have not paid in full. Okay. So 7,000 was my opening creditor, closing balance was 10,000, and the 55,000 is during the year expenses. 55,000 expenses is during the year. What does it mean? It means 55,000 I have incurred an expense during the year. I have taken a services of 55,000. 7,000 was my opening liability. In total, I am supposed to pay 62,000. But still, 10,000 is still outstanding. So net I have paid 52,000, right? So this is what I have actually paid. I have actually paid. So this will go to your, again, cash flow from operation by direct method. 52,000 is your overhead, which is coming from your note number 3. Interest is a financing item, depreciation non-cash item, loss on sale of asset is investing item. This is your cash profit, cash flow from operation is 1 lakh rupees, and you have paid a tax of 30,000 rupees. Your 70,000 rupees cash profit from your operating activity. This is how this cash flow from operating activity needs to be derived by the direct method, right? By the indirect method is pretty simple. You have just used the profit before tax. You have adjusted the depreciation. You have adjusted the investing activity item, financing activity item. You have also adjusted your decrease in inventory. Working capital movement, you remember? Working capital movement. You have also considered decrease in inventory, right? Working capital movement. This is not market value change. This is the actual movement. Increase in trade receivable, increase in trade payable, increase in payable. So net you got 70,000, which is same as of direct method, right? So cash flow from derived from operation is 70,000, is same in both direct method as well as indirect, right? Is that clear, friends? Let me know if you have any doubt. So we have covered this part as well, direct method as well as indirect method. Let's move on to the next activity. Cash flow from investing activity, only direct method. There is no indirect method to investing and financing. This investing activity represents your resources invested, deployed in the long-term assets of the company to generate your future income and cash. So friends, quickly tell me whether it is a investing activity or not. So from the following transactions, from a private sector bank operating in India, friends, again, before answering any question, read it carefully. This illustration talks from the perspective of private sector bank. And for bank, lending money or taking money is not a financing activity. It is not an investing activity, it is an operating activity. The bank main bread and butter is to receive money and lend money. Okay. From the following transaction taken from private sector bank operating in India, identify which transaction will be classified as operating and which would be classified as investing activity. Right? Which transaction will be classified as operating and which transaction would be classified as investing activity. So now you need to tell me operating as well as investing. Friends, this is a bank, right? You need to understand, I have told you the definition of operating activity, investing and financing. Interest received on loans. The bank has received interest on the loans which the bank has given to the customer. Is it an operating activity? Is it an ordinary activity of the business? Yes, it is an ordinary activity of the business. It is an operation of the bank. So interest received is not an investing activity. For a normal entity, had it not been a bank, अगर ये बैंक नहीं होता, एनबीएफसी नहीं होती, तो ये क्या होता है? इंटरेस्ट रिसीव्ड इज अ इन्वेस्टिंग एक्टिविटी. बट फॉर बैंक, interest received is a operating activity. Operating. Interest paid on deposits. The bank has taken the deposits from the customer and the bank is paying interest on those fixed deposits. So it is a operating activity of the bank. Deposit accepted. The bank has accepted the fixed deposit of the customers. Again, it is a cash movement, right? It is a cash movement. So what it would be? What it would be? Again, this third is also your cash flow from operating activity. This is also your cash flow from operating activity. This is also operating. Loan given to customer. Again, operating. If it would not have been a bank, अगर ये बैंक नहीं होता, and the company has given a loan to the subsidiary, then the company's bread and butter is not to give the loan. In that case, it would be investing. Right? Loan repaid by the customer, operating activity. Deposits repaid, operating activity. Commission received, operating activity. Lease rental paid for various branches. Lease rental paid, rent paid. Of course, for branches, it is a operating activity. Service tax paid, operating activity. Furniture purchased, fixed asset purchased, operating or investing? 10 number, operating or investing? Yes, it is an investing activity. It is an investing activity, right? Implementation of upgraded banking software. If you have implemented your intangible asset and you have paid money, right? For example, if it is not clear in the question whether the money outflow or inflow is there or not there, you can give your assumption. Like it is only written implementation of upgraded banking software, right? It is not written that whether the company has paid. So assuming the company has paid, so okay, so it would be investing activity. Purchase of shares in 100% subsidiary for opening a branch in Abu Dhabi. The company has created a subsidiary. The company has invested in a subsidiary. So that investment in subsidiary is not a bread and butter. It is an investing activity. When the company is investing in the subsidiary, it will be your investing activity. New car purchased from Honda dealer in exchange of old cars. So old car given, new car taken, no cash flow. And remaining amount paid in cash, but small amount paid in cash, remaining amount paid in cash. So only the amount paid in cash has to be shown as an investing activity. Provident fund paid for the employees. So it is relating to the operating activity. Issued employee stock options. The company has issued employee stock options. So there is no cash flow when the company issues stock option. But when the company issues share capital, it will be your financing activity if the company is having some money. So it is non-cash, no cash, nothing. Not applicable, nothing. Right? So friend, this is the solution for this, right? As I told you, from number 1 to 9, it is a operating activity. Number 10 was investing, 10 to 13 was investing, and 14 was operating, 15 is no cash. Do let me know if you have any question so far. We have discussed the investing also. Do let me know if you have any questions. If employee exercises option, then it is operating. So Sumit, you need to understand, when employee exercises option, generally what happened? Employee pay exercise price. Okay. And employee pay exercise price and the equity shares has to be issued to the employee. So issue of equity shares, what is kind of item? Issue of equity share is a financing activity. Is a financing activity, right? So if employee pay a exercise price and the company is issuing the equity, it is a financing activity. Vansika provident fund. Why you are paying a provident fund? Because it is an employee. That is why you are deducting or you are paying a provident fund. You are paying provident fund on the salary. And the salary of the employee, is it an operating item, investing item, or a financing item? Why do you need employee? Why business need employee? For operations? For operations ना? Employee नहीं होंगे काम कौन करेगा? Right? Please explain deposit accepted. Deposit accepted means bank. So let's say, Mr. Yedu Kondalu, you went to the bank and you told bank that, Mr. Bank, I want to deposit 1 lakh rupees into your bank. The bank has accepted the deposit. Okay, please deposit 1 lakh rupees into me. So deposit accepted means bank has taken those deposits. It is a liability for the bank, right? For you, if you have invested in fixed deposit of the bank, it is your asset. But for bank, it is obligation, it is liability. Bank has to pay you back, right? Any doubt? Any further doubt? Employee exercise option I have covered. PF transaction, Vansika I have covered. Yedu Kondalu, this deposit accepted meaning I have covered. Yes. Good. So I have covered all the doubts. Pooja is saying bread and butter is important for deciding whether it's operating or investing. Yes, sir. Great example. Thank you, Pooja. You are right. You need to understand what is the ordinary activity of that business. Why that business is there. What is the intent of that business? It is very important. Financing activity, again, simple. Financing activity is something which is related with the equity and borrowing of the entity, right? It helps to the stakeholder in understanding that how the company is financed, right? So who is financing the operations of the company, how this company is financed? So this cash flow from financing activity helps in more in knowing the cash flows from the capital structure of the entity, right? Guys, now the level has been increased. Now you need to tell me, from the following transaction, from a parent company having multiple businesses and multiple segments, there is no bank, no NBFC, it is a normal company. Identify which transaction will be classified as operating, investing, and financing. Identify which transactions will be classified as operating, investing, and financing. Issued preference shares. Issued preference shares. The company has issued. The company has issued share capital. Is it operating, investing, or financing? Is it operating, investing, or financing? Mansa, you are right. Irrespective of the nature of the business, salary is for the business, na? Salary is for the business. So irrespective of the nature of the business, whatever business is there, you need employees for that. Yes, first is your issued preference share is a financing activity, right? You are getting money by issuing the shares. Purchased the shares of 100% subsidiary company. It is investment. The company has invested in subsidiary company. This is an investment. Is it a financing item? Answer is no. The company is not getting the money out of it, right? Or the company is not paying the money which is relating to the capital structure. It is not dividend paid. It is not interest paid kind of thing. So purchase of investment in subsidiary company is a investment. The company is getting a control. It is a strategic investment. Dividend received from share of subsidiary. Dividend received from the investment. Dividend received from the investment. It is a, yes, investing activity. Very good. Dividend received from the other companies. See, the company's bread and butter, the ordinary activity of the company is not to invest in subsidiary. The company had a surplus fund. For the expansion of the business, the company has invested and obtained a control over the subsidiary. And on those investment, the company is getting a return by way of a dividend. So this is an investing activity. Dividend received from other companies is also investing activity. Bonus share issued. Guys, what is bonus shares? You are holding 10 share of a company and you got 10 free shares from the company. So you got the bonus shares. Will you pay any cash for acquiring those bonus shares? Are you paying any cash? Are you paying any cash for acquiring those bonus shares? Answer is no. So there is no cash movement. There is no cash movement. So it is no cash. It is no cash, right? No cash. It is a non-cash item. Right. Purchased a license for manufacturing of special drugs. Intangible asset. Purchased intangible asset. What it is? Purchased intangible asset. Number 4. Yes. Not number 4. Number 6. Yes. Investing activity. Very good. Investing activity. Royalty received. A royalty received from the goods patented by the company. Royalty received from the goods patented by the company. Tell me, what is the answer of it? Royalty received. The company has patented the goods. The company has given the right to the others and the company is getting a royalty. What it will be? The company is getting a royalty. So getting a royalty. So the company is into the business where the company is giving a right to use the company's product to the others. So the royalty is your operating activity. Royalty is your operating activity. It is your operating. It is operating. Rent received from the let out building. And letting out is not the main business. So the company has an investment property. And from the investment property, the company is getting a rent. It is an investing activity, right? Because the main business is not to get the rent. Interest received from loans and advances given. The company has given loans and advances and the company is receiving the interest. Interest received is an investing activity. Had it been a bank or NBFC, it is an operating activity. But in this case, it is an investing activity. Dividend paid. Dividend paid on what? Dividend paid to the shareholder on shares. It is a financing activity relating to the capital structure. Interest paid on security deposits. The company has received security deposits. The company has received security deposits, right? And the company is paying interest. So probably to fund the operation, the company has received the security deposit and the company is paying interest on those security deposits. So what is kind of item it is? It is a financing item. It is a financing item. Purchased goodwill. The company has acquired a business, purchased a business, and the company has paid money for that. So purchased goodwill is investing activity. It is an investing activity. Acquire the asset of a company by issue of equity share. The company has not paid any cash. The company has acquired the asset. The company has issued equity shares. Is there any movement of cash in this transaction? Answer is no. This is a non-cash item. This is a non-cash item. Non-cash item. Right? Interim dividend paid. Doesn't matter. It is a final dividend or interim dividend. It is a financing activity. Dissolve the 100% subsidiary and receive the amount in final settlement. The company has wind up the subsidiary and the company has got the money in the full and final settlement. So this is an investing activity. The company has liquidated the investment. It is an investing activity. So friends, this is the answer of this entire example, operating activity, investing activity, and financing activity? The answer is also given in the PowerPoint presentation. Do let me know if you have any issue. Do let me know if you have any doubt. I will be happy to solve that doubt. Otherwise, I'll move on, right? Sir, how can we get to know that company has the business of patent? So, Tanisha, normally what happened, let me tell you, company does not have a business of the patent. Normally what happened, the company, for example, let's say OnePlus, uh, there is a company and company has, is issuing a OnePlus phones. The brand is OnePlus. The company has patented this brand and the logo OnePlus, right? So that the other will not use that. Number one, you need to understand what is a patent. Patent is a right which is given to the company, right? Where the goods and services which is provided by the company, the other person cannot copy that. Copyright, patent, Sonu Nigam. Sonu Nigam is singing songs, right? And you must have seen in YouTube, sometimes when you want to play songs on YouTube, you will find that, this song is no longer available at this portal. Why? Because of copyright issue. So normally this copyright and patent are for the goods and services which is provided by the company. Now, I am giving you a right that, okay, you can use my logo, but you have to give me a royalty. So by using my logo, my patent, whatever money you are getting from the sale of goods, you have to give me 10% of the royalty out of it. So this is relating to the operating activity. It is not like that the company is in the business of the patent. The company is getting this copyright or patent on the goods and services which is sold by the company. Sir, purchase of goodwill is always treated as investing, whatever the nature of business. Yes, Mansa. So you are purchasing the goodwill means you are purchasing the assets or you are purchasing the business. It is an investing activity. Sir, Pooja is asking 11 answer is financing. Why not investing, sir? Please explain again what is 11. Interest paid on security deposits. So normally what happens, if you are into the business of something where you are getting the security deposit, why? Because you are giving some product. For example, when you obtain a broadband from a telecom companies, they will give you the router. Router has some cost and they will take you the deposit. They will take the deposit from you, but they will not pay any interest on that deposit. Let's say they will not pay any interest on the deposit. Now what happens? Why they have taken the deposit? They have taken the deposit because they want to ensure that you will not damage the property which they have given it to you. Okay. Or when you are getting a let out premises, the landlord is having a security deposit which is non-interest bearing, right? And why the landlord is keeping the security deposit? Just to ensure that you will not damage his house, you will pay the rent on time, so etc etc. He is just securing his sort of interest. But friends, when you are taking a security deposit and you are paying the interest, it means in a way, it is kind of a liability which you are generating, the loan which you are taking, on which you are paying an interest. So in a way, you are funding your operation from the outsiders' money on which you are paying an interest. So it is more in the nature of a loan. That is why it has to be considered as a financing activity, right? Tanisha is saying, got it, sir. Thank you so much for such a detailed and simplified explanation. Thank you, Tanisha. Sumit is saying, sir, point number 6 can also be operating activity. Let me look at point number 6. Never. Purchase license. License is an intangible asset. So fixed asset, intangible asset, purchase, sale. This is always an investing activity. When you obtain license, it is not for the short term, it is for the long term. Means when you obtain license, you get a right to do the business, right? It is a investing activity. It is not a operating activity. Sir, security deposit to electricity department received interest on security deposit. Please explain. So for electricity, you are saying we are paying electricity to the security, to the electricity. We are paying security deposit to the electricity companies, right? And they are also paying interest. So generally, it is in the form of a financing activity, right? Is that clear? Friends, one thing you need to see here, at times what happens, for example, the company is in kind of a business where the company is paying an interest on security deposit. If they are paying a nominal rate of interest like 2%, 3%, it is more like operating activity. But if they are paying a market rate of interest, it is more like a financing activity. You need to look at from that perspective as well. So there could be a situation where the electricity company which are paying only, let's say, 2% or 3%, it can be shown as a operating. But if they are paying 7%, 8%, it is more like a market rate of interest. It has to be shown as a financing, right? But from the examination perspective, if it is an interest bearing security deposit, you can say that it is a financing activity, right? So friend, this part we have discussed. If it is a bank and financial institution, then interest received is an operating activity. But for other entities, it is an investing activity. Interest paid is again for bank and financial institution operating activity. For other entities, financing activity. Dividend received for banks and financial institution operating. For other entities, investing. Dividend paid is financing activity for all the institutions. Why? Because even banks or financial institution will also pay dividend to the shareholder, right? On the equity share capital. So this dividend paid is always a financing activity. Friends, I hope you are able to understand this concept also. You remember we have done a case study on the bank, right? And there I've also told you these concepts, right? Is that clear? Let's discuss illustration number 7 of the ICAI study material. I have a lot of illustration which I've discussed today and I'm going to discuss today as well. So a firm invests in a 5-year bond of another company with a face value of rupees 10 lakh by paying rupees 5 lakh. Today the company is paying 5 lakh rupees, right? And after 5 years, the company will be getting 10 lakh rupees. The effective rate is 15%. The firm recognizes the proportionate interest income in its income statement throughout the period of the bond. Based on the above information, answer the following question. How the interest income will be treated in cash flow statement during the period of the bond? On maturity, whether the receipt of 10 lakhs should be split between interest income and receipt from investment activity. First of all, let me tell you what accounting entry you will pass on day one. You have paid 5 lakh rupees and you will get 10 lakh rupees. So you will pass an accounting entry, investment in bond account debit to bank account 5 lakh rupees. Means there is an actual outflow of 5 lakh rupees. In the first year, you will show this item as an investing activity. Investment in bonds. Money invested in bond, 5 lakh rupees negative, investing activity. Then at the end of 1 year, what you will do? You will pass an accounting entry, investment in bond account debit to interest income account. And you will accrue an interest of 15% on the bond, right? For example, 75,000 you will accrue. Friends, since this 5 lakh will become a 10 lakh in the period of 5 years, and how this 5 become 10? This 5 become 10 because you will be getting interest every year. You will be getting interest every year. And this is how this 5 will become. This 5 will become 10 lakh. So are you getting the actual? Are you getting the actual interest every year? Answer is no. You are accruing interest every year. You are getting the cumulative interest at the end of the period of 5 years. You are getting the cumulative interest. So you will receive 10 lakh rupees in lieu of a deposit of 5 lakh rupees. So when at the end of every year, when you are accruing this interest income, you are just crediting interest income, you are debiting investment in bond or interest accrued. Are you getting any money? Answer is no. There is no cash flow in the 5 years. At that time of maturity, you will get 10 lakh rupees. So when you will get 10 lakh rupees, in that case, you will bifurcate between the redemption of the bond and between the interest income. What accounting entry you will pass? Bank account debit 10 lakh rupees. Two, investment in bond 5 lakh rupees. Two, interest accrued 5 lakh rupees, or two, investment in bond 10 lakh rupees. So in that case, 5 lakh rupee you will show as a amount received from liquidation of bond 5 lakh rupees. Interest received on bond 5 lakh rupees. So the in the cash flow statement, of course, it is a investing activity, and the presentation perspective, this amount will be captured only in the first year when the investment has been made, and only in the last year when the money has been received in terms of principal repayment and interest repayment. Right? Is that clear? There is no accounting entry for the 5-year period. There is no accounting. I hope this illustration is clear. So when these kind of things will come in exam, you need to understand that accounting has to happen on accrual basis, but you need to understand from the perspective of cash receipt. Now some specific point I need to discuss, friends. Foreign currency transaction. The effect of change in exchange rate in cash and cash equivalent held in foreign currency should be reported as a separate part of the reconciliation of cash and cash equivalent. Friends, you know that the assets and the liabilities, okay? So your monetary assets and monetary liability has to be converted at the closing rate. If you have a foreign assets and liability, it has to be converted into the functional currency, into the local currency on the closing rate. Let's say you have a dollar denominated account in USA, and you have a $1,000. You have a $1,000 in the opening, and you have a $1,000 in the closing. But the value of $1,000 in the opening in the comparative balance sheet was 70 rupees. So in your financial statement, you have shown 70,000 rupees. Now the value of dollar become 80. Now in the closing number, in the current year financial statement balance sheet, you will show this 80,000 as a cash and cash equivalent, right? But do you find any movement, any actual movement in the cash and cash equivalent? It was $1,000 in the opening and it is $1,000 in the closing. Have you found any actual movement in the cash and cash equivalent? Answer is no. It was $1,000 in the opening, it is $1,000 in the closing. But in INR numbers, in terms of INR numbers, there is a movement of 10,000 rupees. Friends, don't you think it will be misleading if we will not present the effect of foreign exchange differences? Yeah. So that is why, my dear friend, if the cash in cash equivalent is into a foreign currency, so the effect of changes in cash and cash equivalent due to the change in forex rate has to be shown separately as a reconciliation of cash and cash equivalent. And how it is going to be shown, let me show you. Uh, just give me a minute. I'll show you with the help of the annual report. So just give me a minute. Just give me a minute. I'm just opening that annual report where I need to show you. Yes. So there is a cash flow statement of Hindalco Industries Limited, one of the big Nifty 50 companies. I hope you can see this cash flow statement of Hindalco Industries Limited. Let me take you to the cash and cash equivalent. this is my net increase or decrease in cash and cash equivalent by operating plus investing plus financing. This is my opening cash and cash equivalent, right? And this Hindalco Industries Limited has a cash and cash equivalent in INR as well as in US dollar or in foreign currency, right? So you can see that they have given the effect of exchange variation on cash and cash equivalent by 357 crores. And then this is the number closing cash and cash equivalent, which is telling with your balance sheet, right? Which is telling with your balance sheet. Is that clear? So if the company has a cash and cash equivalent in foreign exchange, the company has to show the changes in cash and cash equivalent due to the rate changes of the forex rate. That has to be shown separately because it is not a cash movement, it is a non-cash movement. But since you need to tally this with the balance sheet, you are required to show it separately, right? Because in the balance sheet, this number has been converted at the closing rate. And that is why you are required to present it separately in the reconciliation. I hope you guys have understood with this real life annual report of Hindalco Industries Limited, right? Sir, which period this belongs to? This is the annual report for 2021, financial year 2021, right? Shall I move forward? Okay. So unrealized gains and losses arising from change in forex rates are not cash flows. That is why we need to show it separately. Friends, are you enjoying the session with this Excel example, with this real life example of annual reports and all? Are you enjoying the session? So today I have seen a lot of responses, right? And it is more than 350 responses so far from the participants in terms of responses, feedbacks, in terms of queries, in terms of replies to the questions. Great. Yes. So now, no netting of inflows and outflows. Second point. So this we have discussed. No netting of inflows and outflows. For example, you have taken a loan from the bank for 100 crores. And during the year, you have repaid 20 crores. So these two transactions has to be shown separately so that the user will be able to understand the company has taken a loan of 100 and the company has paid 20. So no netting means not net 80 crore you will show like loan taken 80 crore. Answer is no. Loan taken 100 crore, loan repaid 20 crores. So this is how you need to present your outflow and inflow in your cash flow statement. Income tax cash flows. Friends, generally the income tax has to be shown as an operating cash flow. You remember in the operating activities, I've done less taxes paid, right? So generally income tax has to be reported as operating cash flow. But if it is specifically belongs to investing and financing item, it has to be shown as an investing and financing cash, right? So let me take you to the Excel file where I'll explain this part. And please confirm if the Excel file is visible. Is it visible? Okay, very good. Friends, important note. If cash flow on account of taxes is not determinable, that how much belong to which activity. For example, you are paying taxes. And first of all, let me give you a thought here. For example, the company is earning a profit out of running a business of 1,000 crore. The company has to pay tax. And the company has also invested in shares, in mutual funds, right? And when the market has gone up, the company has sold those investment in mutual funds and shares. So is it an operating activity? Answer is no. This is an investing activity. And whatever amount the company has gained as a profit, the company has to pay taxes as a capital gain. And whatever capital gain the company is required to pay, whatever capital gain the company is required to pay, it is a taxes, right? But these capital gain taxes is relating to the investing activity, not relating to the operating activity. Because the purchase and sale of investment comes under investing activity. Third example, dividend. If the company is paying a dividend, the company has to pay taxes also, right? But the dividend paid is an example of a financing activity. And if the company needs to pay taxes on dividend, it has to be financing activity. So standard says that if cash flow on account of taxes is not determinable, that how much belongs to which activity, then entire income taxes needs to be shown in operating activity. So the first destination is operating activity. But if you are aware that the specific impact of income tax is determinable, then it is required to be shown in the respective heads of the activity. For example, total income taxes paid 5 lakh rupees, out of which capital gain on sale of mutual fund is 1 lakh rupees. So this is relating to the investing activity. And taxes on account of dividend paid is 2 lakh rupees. It is a financing activity. So we know that on this specific item, these are the taxes. So remaining 2 lakh is operating activity, because if we are not aware that remaining 2 lakh belongs to whom. So if it is not allocable or determinable, take it to the operating activity straightforward. But if it is determinable and you know that this portion belongs to investing, this portion belongs to financing, show it with the respective. Okay. So for example, cash flow from operation is 10 lakh. Income taxes paid 2 lakh. Your cash flow from operating activity will be your 8 lakh rupees. Cash flow from investing activities, let's say 5 lakh rupees. So less income taxes paid, 1 lakh, net 4 lakh. Cash flow from financing activities, 6 lakh rupees. So income taxes paid 2 lakh, net 4 lakh. This is how this taxes has to be, disclosed or presented with the respective activity in the cash flow statement. I hope you guys are able to understand with the help of this example as well. Have you understood this example? Have you understood the impact of income taxes? Very good. Okay, let's move on. Non-cash transaction. So far we have discussed a lot of non-cash transaction. You remember bonus shares we have discussed? You remember the company has acquired assets and issue share capital, issue shares, right? No cash transaction. The company has exchanged new asset with the old asset, no cash transaction. So non-cash transaction is not required to be taken as a part of the cash flow statement, but it has to be disclosed, right? Some disclosure has to be there where you can write that the company has issued bonus shares in the ratio of 1:1. The company has issued shares in lieu of acquisition of the assets of the XYZ entity, right? Only disclosure is required. There is no impact on the cash flow statement. Acquisition or loss of control of subsidiary. The company has invested in a company and acquire a control. It become a subsidiary. It is an investing activity. Right? The company was having 100% subsidiary and now the company has sold the investment. The company has lost control over the subsidiary. The company has sold 80% stake. It is an investing activity, right? But if there is a change in ownership interest in a subsidiary, not resulting in loss of control, for example, the company was having 90% stake and now the company is selling 20% stake. Why? Because the company needs funds. So the company is changing the ownership interest in subsidiary. And when I'm saying changing, I'm talking from the lower side. I'm talking from the decreasing side, not from the increasing side. If the company is increasing the control in the subsidiary, it is an investing activity. But you tell me, if a company has a 100% subsidiary, right? The company has a control. And now the company wants to dilute this investment. Company wants to sell 30%. Still the company will have control, tune of 30%. Means one thing is very clear. It is a strategic investment and the company wants to keep that entity as a subsidiary. The company wants to keep the control with it. But since the company needs money and that is why the company is selling a partial stake. So if there is a change in ownership interest, which is not resulting in loss of control, it will be considered as a financing activity. It means from the sale of that 30%, the company is funding the finance, the company is funding the operations of the entity, right? You understand? So if there is an acquisition of interest, it is always considered as investing activity, right? If there is a loss of control, the company has sold the entire investment, or the company has sold the investment and lost control, it is an investing activity. But if there is a decreasing stake, but it is not losing control, it is a financing. You understood? So it goes by the intent. So these are the specific point which I want to tell you in the foreign currency. Sorry, in the cash flow statement. Yeah. I hope you guys are able to understand these things as well. Now the last part and the important part is foreign currency cash flows. Friends, for example, there is a foreign subsidiary and the transactions are arising in a foreign currency. Okay, so there are two kinds of foreign currency cash flows. Number one, the transactions are arising in a foreign currency. Number two, the foreign currency cash flows of a foreign subsidiary, right? So first of all, I'll distinguish into two parts. Number one, I'll talk about the transaction arising in the foreign currency. For example, I am an Indian entity. My revenues are coming in US dollars. My revenues are coming in US dollars. So what happens? My cash flow is into US dollars. So my transaction is happening in a foreign currency. Let's say sitting on. So every week I am getting a foreign currency cash inflow. So for example, in the first week of April, I got 1000 US dollar. So whatever spot rate was there, for example, that time on 7th of April, the spot rate was 70 rupees. So 1000 multiplied by 70 rupees, I'll pass an accounting entry, bank account debit to foreign revenue account, to revenue from foreign currency. 70,000 rupees I'll record as my 70,000 rupees I'll record as my income and I'll record in my bank, right? Because the spot rate is 70, I'm converting USD into INR. If I have to pay any commission for converting USD into INR, that will be my cost, my expense. So friends, if the transaction is arising from in foreign currency, record this in the entity functional currency means INR. Record this in entity local currency means INR, right? Is that clear? So simple. Foreign currency amount multiplied by the exchange rate between the foreign currency and the entity's local currency on the date of the transaction. Simple. You will come to the Indian currency, local currency, functional currency, and then you can prepare your cash flow statement, right? So very simple, friends. But what happens if you are consolidating a subsidiary which is into a foreign currency, which is a foreign subsidiary? So of course you will get the balance sheet, P&L, and cash flow statement of that subsidiary. So you have a cash flows of a foreign subsidiary, and that foreign subsidiary, let's say US dollar, that foreign subsidiary is in USA, and during the entire year, the foreign subsidiary has generated cash flows. The cash flows, whatever you are prepared, it is not as on date, it is for the year ended. So friends, you are consolidating, you are doing the consolidation on the reporting date. Now what happened? When you are consolidating on the reporting date, you have a number at the end of the year, you have the number. You have a cash collected, you have a cash paid, expenses paid, investment, interest received. It was throughout the year transaction. And you are consolidating at the year end. You have to convert the foreign currency cash flow statement into the local currency cash flow statement. Now, one way is you have to check the detail of the cash flow which was arised during the 365 days, and you need to apply the foreign exchange rate and then you need to arrive at foreign currency cash flow and then you can consolidate. Is it possible? Is it possible? पूरे साल में फॉरेन करेंसी में जो फॉरेन सब्सिडरी है उसने 10 करोड़ यूएस डॉलर का पूरे साल में उठापटक किया है, पूरे साल में उसने ट्रांजेक्शन की है. इज इट पॉसिबल टू डिग आउट व्हाट इज द डे वाइज ट्रांजेक्शन, purchases, sales, interest received, interest paid, dividend received, this, that, blah, blah, blah. Is it possible? Answer is no. So standard says that whatever cash flow statement is there, whatever cash flows are there of that foreign subsidiary in foreign currency, apply a weighted average rate for the full year. For example, the opening balance was 80, the closing balance was 85. So 82.5 is the weighted average rate, for example. So you can apply that one rate on to convert that foreign currency cash flows into the Indian currency or local currency cash. So friends, the moral of the story is, number one, if you are an entity who have the transaction in foreign currency also, you need to convert those transactions into local currency transaction, right? As simple as that. But if you have a foreign operations like a foreign subsidiary and you need to consolidate the result of that foreign subsidiary into INR, what you need to do? You need to convert those cash flow statement into the weighted average rate of that foreign currency into the Indian currency. Is that right? Is that clear, friends? Is that clear? Understood. So now let's come to the example number 3 from ICAI study material. I would request all of you to solve all the problems of the ICAI study material, right? Foreign currency cash flow, right? Entity A, an Indian company, purchased goods for resale from France during January for 10,000 euro. Exchange rate was 1 euro equal to 70 rupees on a credit period of 4 months, right? It accounts for the purchase of inventory at 7 lakh rupees, 17 to 10,000. So when the company has purchased this inventory from Europe, what accounting entry the company has passed? Please write down the accounting entry. Inventory account debit to foreign trade payable account. Why foreign trade payable? Why not cash? Because the goods have been purchased on credit. So inventory account debit, inventory is an asset, stock account debit, inventory account debit, whatever you use, to foreign trade payable account. 10,000 multiply by the rate on the date of transaction, which is 70. 7 lakh rupees से आपको इन्वेंट्री डेबिट करनी पड़ेगी और 7 लाख रुपीस से आपको ट्रेड पेबल क्रेडिट करना पड़ेगा. And this was in the January and the credit period was 4 months. So on 31st March, this transaction was outstanding to be paid. The exchange rate had changed to 1 euro is equal to 65. From 70, it has reduced to 65. So friends, this foreign trade payable, since it is a monetary liability, it is a monetary item, this is required to be restated, right? So what is the accounting entry on 31st March? Because the company got benefit. Now the company does not require to pay 70. The company is required to pay 65. Okay. So 65, 1 euro equal to 65 rupee. The company have to pay less Indian currency to settle this transaction. So what is the accounting entry? The company is having an exchange gain. Trade payable. So this trade payable has to be paid at 6,50,000. So the company will have an exchange gain by 50,000. So accounting entry, please write down the accounting entry. Trade payable account debit, foreign trade payable account debit by 50,000 to unrealized exchange gain by 50,000, right? So on 31st March, the exchange rate has changed to 1 euro equal to 65 rupees. This would mean an unrealized gain due to the exchange fluctuation of 50,000 rupees. Since the payables will be recorded at 6,50,000 at closing exchange rate. So friends, I'm assuming there is no any transaction during the year. Only this transaction was there during the year. So how much profit will be there in your profit and loss account? आपके P&L में कितना प्रॉफिट आएगा? आपको अक्रूवल पे बनाना है ना वो तो. So 50,000 profit will be there in your P&L by way of unrealized foreign exchange gain. So you need to start with your profit. Profit is 50,000 rupees. Then your increase in inventory. So friends, this inventory was purchased during the year. There was no opening inventory. There is only closing inventory. So increase in asset. Whenever there is an increase in asset, what you need to do? You need to increase in asset. You need to deduct. You remember the debtor example? आपका डेटर 100 से 120 हो गया था, मतलब आपको कम पैसा मिला. Means you have a less cash. So that is why it is going to be deducted. And there is an increase in liability also. Increase in liability also. So there was no opening liability, but in closing it is a 6,50,000 liability. What does it mean? It means you have paid nothing. You have a cash surplus. So you increase in liability, you have to add. So this is cash flow from operating activity. This is profit before tax. This is your movement in working capital. Increase in inventory has been reduced. Remember the example. Increase in payable has to be added. Net cash flow from operating activity is zero. And you understand that if you will just figure out this entire transaction, it was acquired on a credit basis. Till the year end, nothing has been paid. Nothing, no any money has been paid. So there is no any cash. And by indirect method, if it would have been prepared as per direct method, we said that cash flow from cash collection from customer zero, cash paid to supplier zero, net cash from operation zero. But since it is an indirect method, we have put the profit 50,000. Then we have adjusted your movement in working capital, which is your this number 7 lakh and 6,50,000, which gives you zero. Okay. I hope you guys have understood this thing now with the help of this illustration from ICAI study material. Yeah. This part I have already covered in the Excel file. The taxes relating to investing activity has to be shown in investing activity. The taxes relating to financing activity has to be shown in the financing. Non-cash transaction, again, we have discussed quickly. Let's discuss this illustration also. X Limited acquire fixed asset of 10 lakh by accepting the liability of 8 lakh and paying 2 lakh in cash. So X Limited acquired 10 lakh rupees of asset and X Limited said to Y Limited that I'll pay 8 lakh rupees later on. 2 lakh I'm paying right now. So what is the net cash movement? It is only 2 lakh. So your cash payment of 2 lakh rupees has to be shown under investing activity, right? Because it is a purchase of fixed asset. This 8 lakh rupees is a non-cash transaction. It will be reflected when it has to be actually paid, right? Components of cash and cash equivalent. We have discussed that the entity is required to disclose the component of cash and cash equivalent and a reconciliation of amount and statement of cash flow with the balance sheet item. Do you remember? I have told you your opening cash and cash equivalent, then you have to put the unrealized gain or loss. You have to show the bank overdraft to just match it with the balance sheet cash and cash equivalent, right? You have to disclose the policy for determining the composition of cash and cash equivalent. What is your cash and cash equivalent? You have to give the policy like cash and cash equivalent is cash on hand, cash at bank, and demand deposits, and those amounts which can be readily convertible into a known amount of cash into the short term period and which does not have a significant risk of change in value, right? So this part we have already discussed. Disclosure, not important from the examination perspective, right? So friends, this illustration number 10, we can quickly go through. An entity has a bank balance in foreign currency aggregating. So this is a cash and cash equivalent in foreign currency, right? Aggregating to $100 equivalent to 4,500 at the opening. Presuming no other transaction taking place, the entity reported a profit before tax of 100 rupees. There is no any transaction, right? But this 100 rupees US dollar value has been increased by 100 rupees. Okay. So of course, in balance sheet, you will prepare on accrual basis. So $100 is $100. In opening, there was a cash of $100. In closing, the cash was $100. Opening, the value was 45 rupees per dollar, 4,500. Closing value become 46, it become 4,600. So there is an increase in the value of asset due to the foreign exchange gain, right? So this become 4,600. So how will you disclose cash and cash equivalent as per the balance sheet? what would be the closing cash and cash equivalent as per the balance sheet, and how will you disclose in the cash flow statement? So friends, in this case, what is your profit? Profit before tax is 100. There is an unrealized exchange gain, right? There is an unrealized exchange gain. Non-cash item, 100, which we need to adjust. Your cash flow from operating activity is 0, investing 0, financing 0, right? Net increase 0. Opening balance of cash and cash equivalent is 4,500. And your closing cash and cash equivalent is also 4,500. H per cash flow. But H per balance sheet, it is 4,600. So you need to show unrealized gain on cash and cash equivalent 100 rupees. So this disclosure you have to give in cash flow statement itself. You can provide this disclosure as a footnote to the cash flow statement, or you can provide here also. For example, 4,500, add unrealized cash and cash equivalent 100, then 4,600 H per balance sheet. You can provide this disclosure in the cash flow statement itself as right. Let me know if you have any doubt, guys. I'm happy to repeat this if you have any doubt so far. Do you have any doubt so far? Is it good to go ahead? Other disclosures, there are a few disclosure also, which is not mandatory, not required from the perspective of examination, right? Coming to the key differences between accounting standard 3 and Ind AS 7. In accounting standard 3, the biggest differences between accounting standard and Ind AS is the treatment of bank overdraft, right? So friends, this accounting standard 3 says that whenever there is an increase or decrease in bank overdraft, it has to be shown in financing activity. But in Ind AS, it is a part of your cash and cash equivalent. Extraordinary item. In Ind AS 1, I have told you there is no concept of extraordinary item. So if there is any cash flow from extraordinary item, it has to be shown in the respective head of operating, investing, and financing. But it is not required to be shown in cash flow statement in Ind AS. Investing activities. So basically, from the guidance perspective, more guidance is given in Ind AS, less guidance was given in AS. Like, as I told you, that there are guidances given in some specific activities, right? Very detailed guidance. Foreign currency cash flow, non-cash transaction. But this kind of guidance was not there in ICAI, in accounting standard. So this is the larger difference between AS3 and Ind AS 7. Thank you so much, friends. Thank you so much. If you have any question, I would be happy to answer in the next 2 minutes. If you don't have any question, I would be happy to conclude the session. Let me know if you have any question. Friends, we started with the cash flow statement where I have told you that how this component of financial statement are there. And for cash flow statement, only Ind AS 7 is relevant. Then I have discussed cash flow from operating activity, investing activity, financing activity. And I discussed that operating activity can be prepared by indirect method as well as direct method. But for investing and financing, it is always a direct method. Operating activity is something which shows the ordinary activity of the entity. It is the activity cash which is required from the operation, cash which is deployed in the operation. Investing activity are something which is, investment in the long-term asset of the business. Financing activities relating to the capital structure of the business, right? And friends, then we talk about what is cash and cash equivalent. We discussed it is cash on hand, and it is short-term highly liquid investment which is convertible into a non-amount of cash without having a risk of change in value, right? Then we discussed a lot of example on operating, investing, financing activity, and the prime intent was whether it will be a operating or investing, you need to look at the business. For example, for the bank, interest receive is an operating activity, but for the other entity, interest receive is an investing activity, right? Then we talked about the specific points relating to the foreign currency transaction, income taxes. There is no netting of inflow and outflow. Whenever there is an acquisition of subsidiary, it is an investing activity, right? So we talked about non-cash transactions. We discussed a lot of, practical life example with the help of annual report. We discussed a lot of example from study material, right? So friends, now I would request each one of you that please solve all the practical example from study material, right? So that you will be able to practice, you will be able to revise, and you will be able to understand this entire chapter in detail. Thank you so much, guys, and we'll meet tomorrow with Ind AS 34. Thank you so much. Bye. Take care.